Ladies and gentlemen, I hope you can all hear me. It's 12:30 Central European time and the right time to start our public consultation meeting. Let me start by wishing you all a Happy New Year and welcoming you to this two-day public consultation meeting on the reports on Pillar 1 and Pillar 2, on the Pillar 1 and Pillar 2 blueprints. Due to the extraordinary circumstances, we are unfortunately not meeting physically in Paris today. Nevertheless, it's a great pleasure for me to meet with you all in this virtual format for this very important meeting. The year 2021 will be decisive for the 137 member states, members of the OECD G20 Inclusive Framework on BEPS, as the inclusive framework is expected, as we all know, to deliver on its mandate by summer of this year. The top priority for the inclusive framework is the development of a global consensus-based solution to the tax challenges of the digitalization of the economy. A major step forward was taken when the blueprint reports on both pillars were agreed by the inclusive framework in October of last year and welcomed by the G20 leaders in November 2020. Although the work on the blueprints has not yet resulted in a fully fledged consensus-based solution, the blueprints demonstrate, I would say, significant progress that has been made to date. Both blueprints reflect the convergent views of the inclusive framework on many of the key policy features of both pillars. And both blueprints identify remaining technical and administrative issues, but also policy issues to be addressed. The consultative process on the blueprints that we launched in October of last year and which continues here today is critical to helping us resolve the remaining technical and administrative issues. The two blueprints have drawn a high level of interest from around the world, with over 200 comments representing a total of around 3,500 pages received from different perspectives, from businesses, from advisors, academia, and also civil society. We, including the OECD Secretariat, or I should say, first of all, the OECD Secretariat, have been carefully examining these comments, and they will be discussed further in technical groups of the inclusive framework. It has been very encouraging to read a strong support expressed for an international consensus-based solution. It is clear that the vast majority of commentators want to see these negotiations brought to a timely and successful conclusion. We also hear loud and clear the concerns expressed about the complexity and the workability of some of the rules and the concepts as such that are contained in the blueprints. Simplification has already played a big role in our discussions in the inclusive framework, and we certainly will continue to be looking to further simplify the proposals wherever possible. The scope definition on Pillar 1 plays a prominent role in the comments. A number of stakeholders consider that all businesses should be treated equally under Pillar 1. In addition, in particular, NGOs have expressed concerns about the new scope of reform and the, in their view, limited amount of profits to be redistributed. Clearly, we have a lot to discuss, and we will not be able to discuss all of the comments received in detail. But rest assured that the input already received and the discussions we will have over the next 2 days, today and tomorrow, will be taken on board when the inclusive framework further refines the proposals into real-world and hopefully implementable solutions. Already work is underway on further simplifications that applies to both pillars to make the final product as administrable as possible. And this is true for both for taxpayers and also certainly for tax administrations. Beyond the technical and implementation issues that remain to be resolved, there are the fundamental policy ones, such as the scope of amount A, also the quantum and the rate for Pillar 2. The inclusive framework looks forward to the speedy resumption of discussions at the political level to bridge the divergent views so that a consensus can be reached as soon as possible. It's also clear that this will require the involvement of the new incoming US administration, and we will be seeking early engagement with the United States on this issue at all levels. In the meantime, the work is continuing at the technical level to advance the work on Pillar 1 and Pillar 2 as far as possible. So let me thank you all again for helping us with this really challenging task, and I look much forward to hearing your input over the next 2 days. As you can see in the agenda, we start this Pascal Santamont, the director of the Center for Tax Policy and Administration at the OECD. And Pascal will give us a background on the work and the progress and that the inclusive framework has made so far. Pascal, the floor is yours.
Thank you so much, Martin. You cannot see me because I cannot start my video. The host who's from the team does not allow me to put the video because he or she might consider I look too bad for that. So glad to see you and glad that you don't see me in a sense. And Happy New Year to you all. Thank you a lot, Martin, for your introduction and for chairing the meeting today. And for your steer of this very important work. Now you can see me, I think. I don't have much to add to your introduction, Martin. Maybe just a couple of words to put that in perspective. As you all know, we had a mandate to deliver a consensus-based solution by the end of 2020. We did not, but the G20 and the members of the Inclusive Framework considered that there was a solid basis for future agreement, and as a result, they suggested to extend the deadline by mid-21. So here we are, and we have 6 months to move ahead. As Martin indicated, one of the key partners, key countries to reach a consensus with is the United States of America, where there is a process of transition, a new team, and we all know that it takes some time in the US, whatever the circumstances, the political circumstances are, and the current one may delay further the situation, but it takes time to have the new interlocutor. So we are, in a sense, in a waiting mode to get signals from the US, knowing that in the G20, there will be a G20 finance ministers meeting at the end of February, where hopefully the new Secretary for Treasury or acting Secretary for Treasury will participate and may send signals or not. There is another one in April, and finally the one where we'll have to report not only on progress but hopefully on a solution will be held in Venezia in Italy, hopefully physically in the early days of July. So while we are waiting to have signals from the US on what their intent is and if there is an intent to reach a consensus by mid-year, what the basis would be, we are working actively because we're all colleagues, but also because we must make progress. As the chair said, we issued 2 blueprints, and we have consulted you, the public, on the blueprints. First, we'd like to thank you for the comments received, which overall we take, and maybe it's wishful thinking, but we take that a very large majority is at least neutral, if not positive, on the fact that we must have a consensus-based solution and that there is support for a multilateral solution. We have positive comments, we have less positive comments on the blueprints themselves, but overall we have very, very good input from the public, in particular on how, on the fact that we must simplify, and I think we all agree, and we all the more agree as the blueprints reflect a state of play in the negotiation which did not facilitate the mainstreaming of what's in there. In other words, when you don't have an agreement, many countries keep their positions, which means that you have several layers, and several layers means complexity of the blueprint. So the complexity, as you can see it from the blueprint, because of the level of negotiation, of the state of play of the negotiation, is even bigger than the intrinsic complexity of the solution. So the first message we have is simplify, and then we have a number of proposals and ideas on how to simplify. So working with the members within the steering group, within the task force on the digital economy as regards Pillar 1, with Working Party 1 on tax treaty, Working Party 6 on transfer pricing, we are working actively in trying to figure out how we can simplify the pillar, and using the coming weeks and probably a couple of months to advance as much as possible technical work, at least to solve what needs to be solved from the current architecture, whatever happens to this architecture. So this is what we are doing, and that's why the meeting today and tomorrow for Blueprint 2 is extremely important, because what will emerge from the discussion will help us shape further the report, the blueprint, the solution, and we very much look forward to listening to you. So on that note, Martin, again, thank you all for participating. Happy New Year, or as happy as possible given the circumstances, and thanks to TUAC and BIAC in particular for their involvement in the process. I can see Pierre and Will on the screen, so a personal hello to them both. Martin, over to you. Thank you.
Need to unmute. Thanks very much, Pascal. And I'd now like to invite two more very important stakeholders, Will Morris from the Business and Industry Advisory Committee to the OECD, and Pierre Hubbard from TUAC. And I think, Will, we start with you to deliver your opening remarks, your remarks. Will, please.
Thank you very much, Martin, and thank you very much, Pascal. And yes, a very happy New Year, or at least a happier New Year to all 388 participants on this call. It's good to be with you. And I'd just like to formally thank the OECD and the Inclusive Framework for the opportunity to comment at this public consultation. It's not quite the same, as Martin said, as being in a room with 300 or 400 of your closest friends. But this is about as good as it gets, and it is good to have this opportunity. The time of COVID has made all types of interactions more difficult, but I would like to give credit to the OECD through many Zoom meetings for facilitating what has been possible, and obviously we all look forward for in-person meetings to resume once the vaccine kicks in. I'd also like to say how glad I am, as always, to be with my friend Pierre Hubbard on this, and to say that we agree with many of the comments that TUAC put in on this, both on the complexity, which Pascal has already mentioned, and a point which I'm not really going to belabor, but also some of the comments on Pillar 2 and the need to streamline this and to make it work. So I think fairly significant areas of agreement there by the two major stakeholders into this. As Pascal said, I think there is a huge amount of support in the business community and the wider stakeholder community for a multilateral agreement. That's not to say, as you'll have seen from the 3,000 pages of comments, that there aren't considerable concerns about some elements of this, and not just the complexity as such, but some of the issues around scope, for example, around segmentation, around dispute resolution, and indeed around Pillar 2. But there is, nevertheless, a recognition that a good, principled, less complex multilateral agreement is vastly preferable to countries going on their own, whether in the Pillar 1 space or in the Pillar 2 space. So I think there is still the opportunity to do that. I don't think that we should underestimate the difficulties of that. I don't think anybody underestimates the difficulties of that. But there's always a point in these remarks for a Churchill quote, so I'll give you the appropriate one here, which is that the optimist sees the opportunity in every problem, and the pessimist sees the problem in every opportunity. So I think that we have to try to see what the opportunities are here, and to work them through. And certainly BEAC will do its best, and I believe that the broader business community will do that as well to try to carry this over the line. I would be remiss if I didn't salute the huge amount of work that the Secretariat and the Inclusive Framework have done in bringing the blueprints to this stage. I think we all acknowledge that given the way that the timing worked out, particularly last year, that there are some elements of the blueprint which clearly don't represent consensus, were never meant to represent consensus when put out. But the amount of work which has gone into this has been almost literally Herculean, and that should be acknowledged, and we're very glad to do that. One of the issues which has arisen, and the BEAC comments reflect this, but I think many of the business comments taken as a whole reflect this as well, which is that given the significant scope of this project in so many ways, much broader than any one of the BEPS issues, it has been difficult to come up with a single business point of view on many of the significant issues. That will require time, and indeed it may well be, given the differing effects of these proposals on different sectors, that's simply not going to be possible. Nevertheless, as Pascal said, I do think that many of the comments which have come in have been very helpful. I hope have been constructive, and will move us towards at least the possibility of an agreement on this. Just one sort of slightly more specific point on Amount A. I do think, and again, our comments say this, I do think that one of the problems with Amount A is that the problem that Amount A is trying to solve has not been completely clearly articulated, and the principles upon which that unarticulated problem, by which they might be solved, have also not been completely articulated. And I do think that in the remaining time, one of the things that all of us have talked about is the possibility of narrowing down Amount A in some way, whether that's by reducing the scope, whether it's by raising the threshold, whether it's by doing a pilot project, any number of ways of being able to focus this in on what certainly BEAC has been clear from the very beginning of this project is a genuine tax issue to be solved, which is the ability remotely to create value in a country, and the fact that the rules currently do not allow for the taxation, or at least not the appropriate taxation of that. We do believe that is a genuine problem to be solved. Looking at current Amount A, it is a little hard to discern that amongst the other things that are in there. And I do think that maybe as we think about narrowing this down, about starting it off in a slightly different way, I think that will help us with that. And likewise on Pillar 2, which, again, I think most people agree is at its heart a valid principle. I do think that the complexity, particularly amongst 137 countries, maybe more, is quite significant. And, I think we need to, and I know the OECD is, I know the Secretariat is, the WP11 is, and we'll hear more about this tomorrow, thinking of ways of both reducing the complexity, but also perhaps in some respects simplifying dramatically by not requiring a full process to be gone through in every single case. There must be ways of making this simpler, because there are going to be many instances where the calculations will prove out what your eyes would tell you in the first place, which is that there are countries where this is simply not an issue. So again, I think finding ways of simplifying that would be very helpful. All of that said, I come back to Pascal's basic point, which is that the reason I think why now 400 of us are on this phone call, this Zoom meeting, is because we want a good, functioning, multilateral agreement which brings back stability to the international tax scene, which allows businesses to engage in international trade and investment, which obviously in the end is the OECD's core mission, the founding mission, to engage in that international trade and investment, to create jobs, to help grow us out of the terrible, terrible economic situation that many countries and many businesses find themselves in, while at the same time, as I said, not just restoring stability, but also ensuring that governments can collect revenue on profit which is created in their countries, and which can be used to fund, again, some of the staggering costs which have been incurred dealing with the COVID crisis over the past year and the recovery which is to come. So I think we all want that. 6 months is, to be sure, a short period of time, but I think, if we don't try and do this and we don't give it our best efforts, then shame on us. So with that, Martin, let me hand it back to you.
Thanks very much, Will, and I think that everybody will agree that stability in the system is of utmost importance. Let me now give the floor to Pierre Hubbard, please. Yeah, please.
Thank you, Chair, and thanks for giving us the opportunity to share comments. I'll share with you 3 sources of concerns that you can hopefully bring on board, and then perhaps 2 propositions to move forward from a trading point of view. First, yes, absolutely, complexity. That is a recurrent matter, and Will Morris brought that up, as well as you, Chair, complexity of the issue. With the 2 blueprints, which, as you mentioned, are several hundred pages long, what we regret from a trading perspective, and that is that we are being brought into a high dose of technicalities, and we are not then able to be consulted on the broad policy process, on the broader policy orientations that you're aiming at. This issue of technicalities is more than an issue for tax experts. It's also an issue of policy coherence. Much of this process is locked down between tax experts. It's a discussion between tax experts. To our knowledge, you have not consulted properly employment people, other committees at the OECD or at the G20 on your proposals. And there are implications on when it comes to the job employment implications, the environment, the trade and investments. So this issue of technicalities is not just an issue of understanding; it's also an issue of policy coherence, which leads you to sometimes to developing concepts that are not necessarily completely stabilized. I mean, if you ask me, consumer-facing business, I still have the difficulty to understand exactly what the scope of it is as we speak. Chair, you mentioned that we're meeting today virtually. This is more than a technical source of annoyance for all of us. If we're meeting virtually, it's because we are experiencing the worst and most violent crisis in modern history. As we speak, a lot of people have lost their jobs. The lives of people have been destroyed, literally in terms of health matter, but also when it comes to their sustainable livelihoods. That's a context. That's a real context. We should remind that. Unemployment is skyrocketing all over the place. We have a rise of inequality, and we know it. That since the beginning of this pandemic, there is one source of big winner. There are big winners out there of that crisis. That's the evidence. And these are the highly digitalized businesses. That's not a criticism, that's just the evidence. We also know the evidence is that because they have business models that are disruptive, they are, from a trading point of view at least, they are undertaxed. So that's a context to that. I mentioned that because, as you can imagine, for my constituency, the expectations are still high that you deliver on both pillars. But the context is that the worst possible crisis, a looming crisis of confidence in business at large, and the fact that, as we see, this is a crisis that is delivering big winners on one side, that have an asymmetrical impact with many losers, and one sector, big winners, the highly digitalized businesses who are de facto, the evidence is there, undertaxed. The third point that we want to bring with you, and that's not new, and that's will come as a no surprise from a trading point of view, is again and again, please do a better job in having a stakeholder approach to your discussion. Tax matters are too important to be left to the tax experts and to the tax lawyers. We appreciate the public consultation process that you have, and we've noted the many contributions that were made, which shows obviously the importance of that topic. But in an ocean, so to speak, of contribution from business, there was only a very handful of contributions from civil society. I will acknowledge a submission by the NGO coalitions, by the BEPS monitoring group, by Oxfam, by the Austrian Chamber of Labor. That's really too little. Much of it is due to the complexity of the issue. But I would want to ensure that the voice of civil society, the voice of trade unions, is taken due on board. Because the topic that we're discussing should not be limited to a conversation between, on the one hand, tax administrations, and on the other, tax lawyers and their tax experts. So from there, true proposition to move forward. For trade unions, and I guess I will surely not speak on behalf of NGOs, but I think that there is on our side, civil society, a lot of expectation regarding Pillar 2. You have the possibility to deliver a robust agreement on Pillar 2 and have a framework that can at least come up with some minimum floor when it comes to taxation. It is important that you therefore decouple the negotiations between Pillar 1 and Pillar 2. We obviously, and I come back on that, we can only hope for the best on Pillar 1. But it is important that you do not create conditionalities between the two pillars, and that you you deliver a robust agreement on Pillar 2, irrespective of the concerns, the barriers with Pillar 1. I don't want to go too much in details, but the expectation would be to have a minimum floor, tax floor, that is relevant. 12.5% is not a minimum. This is aligning the floor with the most aggressive jurisdictions when it comes to tax. It should be between 20 and 25%, which is the average statutory tax rate. It is also important that you ensure some fair balance between the income inclusion rule between residents and source countries when it comes to the distribution of those rights. Hopefully, that could be addressed in a instruments that you could set up, a multilateral instruments to ensure this fair balance between the sources, between the taxing rights, between residents and source countries. We would also expect that you lower the threshold. The issue here below 750 million turnover. This is it matters for the level playing field, clearly. Regarding Pillar 2, and I'll finish on that, Pillar 1, sorry. Clearly, this is a bit of a repetition of the discussion we had, that you had in 2013 and 2015, with as part of the first BEPS action plan. It holds, on the long term, it holds many promises, but does the current blueprint, is it ready to fly? We must admit on the union side that we have concerns about, as you mentioned, and I think Will Morris mentioned that, about the complexity, about scoping issues. We do believe that you should go far beyond in revising the rules applying to international corporate taxation, and to move severely away from the arm's length principles. The transfer pricing guidelines, I think today, are around 800 pages long, something like that. With the upcoming revision, it should easily reach 1,000 pages. 800 pages, that's 800 ways for tax lawyers to game the tax administration. The only tax certainty we have today is that with the current transfer pricing guidelines, it is a framework that is self-serving for business, that allow for far too many opportunities for business to game the tax administration, even the most powerful tax administration. So the more fundamental question, if you talk about simplification, is to move toward unitary taxation. Our second proposition when it comes to Pillar 1 is, given the major concerns and for cause about scoping issues, is to refocus the discussion on excess profit taxation. You allude to that in the text, but that would be, rather than getting drawn into discussion on scoping, let's have a conversation on global excess profit taxation for all businesses when it comes to their exposure to market countries. To finish, there is sometimes a catch-22 situation where we are. If you have concerns, if there is an issue with complexity, if there is an issue with clarity, with scoping issues, it's because very often you do not have the data. You do not have sufficient access to corporate information on tax. And there is a catch-22. We need to move ahead to have far more corporate tax transparency. In 2015, you agreed on a country-by-country reporting framework. Sadly enough, it was not made public. This is a severe barrier to a good understanding of the situation, to a good understanding of the issues that we are dealing with. So with that, I'll leave it there, Chair. And again, thank you for giving us the opportunity to contribute.
Thanks very much, Pierre. And I can assure you that we are trying to be as inclusive as possible. And it's a bit also in the nature of the inclusive framework. It carries the inclusiveness already in its name. So we will now be given an overview on the comments that we have received. We have 15 minutes reserved for a relatively brief overview on the comments. And I think it's Achim who will lead us through the comments that we have received. Achim, please.
Thank you, Martin. Welcome to everybody. I will take you through in the momentous task of trying to do all of the comments, 1,800 pages on Pillar 1 in 15 minutes. It would be impossible for me to do this on my own, so I'll split it with Matt, who will do the second part. So if we can bring up the slides, then I will walk you through. We do have a couple of slides, as you would expect. Here they come. And some of these slides, I think we can be relatively brief. If we go to the first one, this is a breakdown. We can make this available so you get a bit of a sense of who's been submitting, where these submissions are coming from, the total quantity of the submissions. I'm not going to walk you through this. Suffice it to say, we are extremely grateful for the level of contributions, for the diversity of the contributions, for the technical detail in the contributions. We're much pleased and most pleased that, a number of you not only pointed out issues and problems, but then also offered solutions to these problems. So very, very grateful. I guess, as Pascal has already said, we will be taking those away. We canceled Christmas, we read them. We didn't have much else to do anyway, but we will, and more importantly, also take these comments in the technical working parties, breaking them down by subject matter and looking where we can find further simplifications. It's certainly a big theme, where we can find more intelligent solutions. So very, very useful in terms of the input. And maybe also the last point, a truly global process. We also received input from all corners of the world, different constituency, different businesses. So much appreciated. Thank you very much. If I go to the next slide, and on this one, I can be really, really brief, because in some sense, you've already heard from Pierre and Will and Martin and Pascal, what are the different themes? So I think that's just a repetition of what you've heard. I think we overall do have strong support from all parts and different constituency for a global, structurally sound solution based on net taxation that avoids double taxation and that is sustainable going forward. I think there is agreement and people are concerned about the alternative and what this might look like. And there is agreement that this involves the removal of unilateral measures. So all of these messages we've heard loud and clear. There are questions, as Will has articulated, about the uncertainty about certain policy objectives and principles, I think in particular in Pillar 1, and that is, as we recognize, the political question on scope from which flows some of the answers to that question. So you can't be surprised that that is not answered if that question is not settled. Calls for greater simplification to reduce complexity and compliance costs. We heed those. The delegates are aware of those. We are trying. And we are continuing our efforts and have even over the last 2.5 months, our efforts to try to remove and look at every piece in the engineering, see whether we need it, see whether we can make it easier, see whether we can replace it. There is also, and I think this is something positive that we see when we look under the hood, just in a little more detail, when we go into the elements that make up the pillar, then we do see a not insignificant degree of convergence on a number of the technical parts in the amount A building block. So that would be very helpful for the ongoing discussion, a technical and less technical dimension. So thanks for that. We also recognize there's some other building blocks where divergences cut across delegates, but they equally cut across, as Will has said, different voices in the business community. And it's also useful to see that there isn't one voice of business and one voice of government, but there is a diversity that can be helpful also in finding a consensus. And I guess the points that Pierre has already made, I don't need to repeat. I mean, that's the last observation in our summary. I get then, this is a super quick recap. You are aware of all of these different elements. We've used them, they're in the blueprint, so I don't need to tell you that, the pillar 1 is made up of amount A, of amount B, and the tax certainty dimension, together with an implementation, including also the US proposal on safe harbor and an administration. All of these things do need to be resolved, and we've tried to make as much progress in the blueprint. As Pascal has said, the blueprint in some sense may read more complicated than it may actually be, given that there is a lot of layers of different positions that have been recorded in the blueprint. And with a momentum towards a resolution, I think we can maybe move relatively quickly on a number of these issues, which may not be readily apparent from the text of the blueprint. If I then go to the first question on scope, where many of you have commented, and in some sense, we've already heard that. There is, if you try to group it, which is always a little difficult, but if we attempted to make sense of the range of views here, there is a number of commentators that argue for a wider scope, an all-inclusive scope. Many digital businesses argue for quantitative approaches to scope based on indicators, metrics available from financial statements, revenue, profitability, to avoid ring fencing. We also have some others that have variations on the scope based on remote sales where revenue is booked outside the market. You've heard from Pierre just now that NGOs also support a broader scope with no distinctions. So that's one thing. There's, of course, question on the policy, and there's questions on the technicality of the ability to implement so that these approaches wouldn't turn out to be more complicated rather than simpler. So these are one group of comments. There is another group of comments that, while necessarily supporting or not supporting, but certainly talking on the basis of the existing scope. And their comments are, on CFB, consumer-facing, specific comments where maybe pharma should be in, pharma should be out, prescription drugs out. Particular concerns expressed by franchise businesses that, their business model and the profit in the market should be adequately reflected. Telecommunications will take all of those away, including, of course, also, the wider points on scope as we move forward in the discussion. So I'm just telling you what you told us so that you don't have to read what everybody sent in. On ADS, the automatic digital services, a number of commentators pointing out the challenges in including B2B cloud and B2B software, both from the perspective of scoping and the perspective of revenue sourcing, trying to get questions of administrability, feasibility here. So we're grateful for those comments. Then running through the other comments that we have identified here, there is a small number of commentators that favor a US safe harbor approach. There is a small number of commentators that argue for an IDS-only scope. There is some commentators, and you see there's sort of fine distinction, what's some, what's small, but we're trying to sort of give you a flavor, so that's not science, of commentators that argue for variations on transition, phase-in rules with different options, including start with larger businesses, keep the complexity lower by going for higher thresholds. That also makes the tax certainty process workable. So start small and build out, and the key and easiest metric is essentially gross revenue, so start at a higher level. Some others have a variation and argue one should start with ADS and then potentially build out in CFB. And then we also have interesting submissions from a number of you that somewhat come back to safe harbor, but not quite, start on a trial basis with an agreement. So there's many interesting ideas and permutations of different phasing approaches. And then the last point, I think, is a point that already made. A number of you said, well, I would be in a better position to comment on the particular scope had you set out specifically what the objective is that then explains that. And that's a point that I've already acknowledged. That's the question around scope. I should mention, which is not on the slide, that there's also a number of alternative proposals that have been made. You've heard one from civil society. We will also hear from some of those that made alternative proposals that are not wider scope, narrow scope, but have slightly alternative models as we go through the day. Then the second part on scope is not the activity-based part, it's the questions around thresholds here. And there we had a couple of specific questions, and I think the messages from the majority of commentators are quite clear. There is broad support for a de minimis foreign in-scope revenue exception. Remember, there's an idea that if you have very little money that would be reallocated, is it worthwhile from a cost-benefit analysis to have companies go through the process if at the end of the process we already know before going in there would be a very small reallocation? I think that's very broadly supported, but people do recognize the challenges in defining what is domestic in many different situations and permutations. The second point here is very clearly there's very strong support for a global revenue threshold in excess of 750 million for a whole host of reasons, including the availability of financial statements, having the capacity in the tax administration for the process, and of course also pointing out that if you go below even at a high net margin on some assumption of the amount A reallocation, the cost-benefit analysis would suggest there is not that much money that would be reallocated. And finally, and I mentioned this before, I think there's also the point that several commentators say start small, learn, and then build out. So have a phased in, a roadmap to lower threshold, but go higher in the beginning, wherever those numbers might be, and then take it down as you gain in experience over a particular period of time. Then my last slide here, going to the next one. Nexus and revenue sourcing, I can be quick. I think there is broad support for using a revenue threshold for Nexus with different amounts suggested. There is broad concern about the feasibility of plus factors and a significant concern being voiced that they may create excessive compliance costs for businesses, but also for tax administration, including in the tax certainty process, but not only. So a big word of caution on the use of plus factors and a preference for thresholds, even if that might mean they're higher. That's largely, I think, what we're hearing from business. Then I think on the question of revenue sourcing, I think we broadly read this as suggesting that the architecture works, subject to a number of comments. We try to bring out maybe the three most significant ones. More flexibility on hierarchy. There is a hierarchy in the sourcing rules. Many commentators say, don't remove the hierarchy or otherwise make it more workable so that I can use what's most appropriate without having to prove into the hierarchy. Big concerns, I think, around B2B transactions, whether that's the cloud, but also distribution, third-party distributors. How can I do this? Do I have the information? How can I do the information? So very useful input in the design of getting the right balance here. And then finally, there's also a number of technical concerns around IP address, geolocation, et cetera. I can't go through that. But that's maybe the high-level messaging on scope, nexus, and revenue sourcing, and then over to Matt, I think.
Thanks very much, Hakeem. On tax-based, commentators generally recognised amount A can't always be calculated from consolidated financial accounts, and that some form of segmentation would be required to deliver the policy objective of amount A. Nevertheless, commentators did recognise that segmentation can lead to quite substantial complexity and compliance costs, and therefore There was general support for number one, a safe harbour based on a higher revenue threshold to limit the segmentation requirement only to the largest M&Es. Number two, an exemption where there's limited variation in profitability between different segments. And thirdly, using existing data and financial accounting segments where possible. And that's an important part, that third point, that is to reduce compliance costs to a minimum. Commentators did suggest that businesses should be able to use their segment as they disclose them in their financial accounts. And that's an important point that was made. Commentators noted that disclosed segments reflect their business, and that they also argue that if the businesses disclose their segments based on the region, they should be allowed to use them to calculate their tax base. On the hallmarks, there was a point on that. The majority of commentators considered that the proposed hallmarks under IAS 14 involve subjective judgments and probably create unnecessary complexity and uncertainty. There were a small amount of commentators which were looking to or supportive of introducing further guidance around that. Lastly, for the calculation of the PBT, the profit before tax measure, there was a strong convergence among commentators on several points. For example, permitting taxpayers to allocate direct costs on a factual basis and avoiding adjustments for inter-segment transactions. On losses, on the next slide, commentators were broadly endorsed the different features as they were listed in the blueprint. For example, almost all commentators supported the proposed earn-out approach. That is, losses should not be allocated to the market jurisdictions, but reported and administered through a single account for the M&E group and carried forward. Most commentators also supported the inclusion of pre-regime losses and thought that was appropriate in terms and necessary to avoid taxation of artificial profits, and that these losses should be able to be carried forward with no time limitation. However, some commentators, based on an equity argument, suggested that there should potentially be some time limit in the past period for pre-regime losses, and there were suggestions about 20 years, 10 years, 5 years, or 3 years. And there was also strong support for unlimited loss carry forward. As it relates to double counting on the next slide, there was widespread support for the marketing and distribution profit safe harbour from business and advisors. There was a recognition by commentators that even though the marketing distributor safe harbour is complex to design, there is overall support for the approach to reduce and eliminate the allocation of Amount A tax liability to jurisdictions. In terms of that complexity, there were features and input provided from commentators in terms of how the fixed return for those baseline activities should be set. Some commentators suggested it should be set through the arm's length principle, others by reference to the Amount A profitability threshold, and others even by reference to Amount B. On the notion of domestic business exemption, there was some support for commentators on this, but not very much detail provided as to how it should actually be designed. And it was also noted on double counting, businesses and advisors opposed the application of Amount A on top of withholding taxes. And they considered that the receipt of an Amount A tax liability should be conditional on eliminating these types of taxes. Turning now to elimination of double taxation on the next slide, some commentators expressed concern about the complexity leading to the effective relief of double taxation. And so, for example, commentators expressed concerns that the four-step process, which was outlined in the blueprint, may actually inhibit the relief of double taxation or would increase the risk of disputes. On identifying the paying entity, there is support for the activities test over the profitability test. Many commentators advocated maybe relying primarily or solely on the activities test because of concerns about a profitability test being calculated based on payroll and tangible assets, which there could be variances in payroll costs, valuation of asset differences, or the need for the preparation of detailed and unaudited entity level accounts. However, there were some commentators which did want to explore further the formulaic approach to identifying the taxpayer. While commentators recognised the need for the marketing connection priority test in order to avoid allocating amount A tax liabilities between entities that might appear arbitrary. They also shared concerns over the complexity of designing this. And lastly, on elimination of double taxation, businesses and advisors prefer the exemption over the credit method. Commentators were concerned that if the credit method is used to relieve double tax, domestic law limitations on credits will undermine the ability to effectively claim double tax relief. Lastly, from me, turning to amount B on the next slide, there was strong support for the objectives that underpin amount B, namely that amount B would reduce existing TB disputes if designed appropriately and would be consistent with an administratively simplified application of the arm's length principle. However, there were divergent views on how amount B should actually be developed, particularly in relation to scope. And so there were some commentators which sought a broader scope and thought that could be beneficial, including the types of models such as commissionaires and multifunctional entities. However, others argued that might lead to administration issues. And so others sought a narrower scope and thought that might be beneficial in terms of management and a realistic in terms of implementing in practice to reduce the workload of disputes. And some commentators are also concerned that a broader scope would make it more difficult to align amount B with the arm's length principle with different levels of functionality, for example. And some commentators suggested that amount E should actually be a safe harbor or applied on an optional basis by the taxpayer. So accordingly, there were many different views and concerns expressed on the amount B design. Turning now back to Akim on tax certainty.
And I will do the last slide. We're setting a bad example by overshooting our own time, so I'll be very quick here as much as I can, but it is tax certainty, a key part of everything we're doing here, so I don't want to do it too fast. I think the message here clearly and unsurprisingly, certainly from business, is a very strong support, even a conditionality in some sense, for mandatory binding dispute prevention or resolution for amount A, but making sure you get to a certain outcome eventually and sooner rather than later. So clearly that comes out. And that also, is articulated in particular here as we're breaking it down for amount A. I think the points, I wouldn't necessarily call them concerns, but, points of caution and input are around, is it realistic? Can this be done? Timing, resources, and again, this links to the question of thresholds, very importantly, how many people do you take through the process? How can you simplify the process so the process doesn't get overloaded too quickly, and can you deliver? And then many, many very useful, grateful suggestions on how you can streamline, redesign, improve the process. So there's a wealth of comments that have come in that I think should put us in a position to make this process more effective and better and faster and hopefully appropriate for the level of decision that we need to take. Then moving on, I think there's also broad support for, that's not quite yet, so still on the same slide, broad support for, resolution of issues beyond amount A, not just the amount A, but also transfer pricing. We have a public consultation on Action 14 coming soon. So that is an issue inside the pillar and outside the pillar, but of course also a word of caution. I think that we've heard from NGOs, but also from a number of members of the IF on, mandatory binding resolution, both from their constitutional sovereignty considerations. That I think we will be able to highlight in the panel, certainly panel 2 later on today. So we're going to go through all of these issues. With this, I think I give it back to the chair, and sorry for the slight delay.
Thanks very much, Matt and Achim, for this overview. I think this is already a good basis for the discussions we are having today, the 2 panel discussions for the first day of our public consultations, focusing on Pillar 1. And we have picked 2 quite prominent themes for this afternoon. As you see in the agenda, we will first focus on complexity, of course, on reducing complexity in Pillar 1. And the second panel will then focus on tax certainty. And we already have heard that from Pierre and also from Will that both of those themes are extremely important, both for businesses, but also I think for QAC and certainly also for the tax administrations. So we picked those two main themes for this afternoon. The first panel will be moderated by Matt, and we have 90 minutes time to discuss the tax complexity issues behind Pillar 1, or in the context of Pillar 1. And Matt, I hand over to you, and I think you will introduce your panelists and participants of your panel. Matt, please.
Thank you, Mr. Chair. I will do that. So thank you, Mr. Chair, and hello to everyone and Happy New Year as well. So as mentioned by the Chair, Panel 1 will be discussing and the topic of reducing complexity. And so that's obviously been a key point which has been discussed so far already in the public consultation. So many stakeholders have argued that the current complexity will lead to high compliance costs and could potentially give rise to more disputes between taxpayers and tax administrations. So simplifying some features of Pillar 1 is thus a top priority. And with the panel today, on Panel 1, we will discuss several potential simplifications in the areas of Nexus, segmentation, profit allocation, revenue sourcing, and elimination of double taxation. And these are the features of Amount A that have been identified as the most complex by respondents to the public consultation, and in particularly the most technically complex. So to discuss this, we've invited 5 panelists whose comments are representative of the discussions found within the responses of the public consultation. We'll be asking our speakers to make a short intervention on a topic related to the reduction of complexity in Amount A. I do note that some speakers may have slides, which they will speak to the slides. After the discussion, there'll be an opportunity for brief additional reactions and comments from the floor, so to speak. If you do have questions, can you please use the chat function and put your questions in the online chat? My colleague, Eric Robert, will collate these, and we hope to have some time after the panel to raise these questions and comments, and we will do our best to do this if possible. So I'd like to welcome, at this point in time, the panelists. So I welcome Louise Weingrod, who is the Vice President, Global Taxation, Johnson & Johnson. Our second panelist will be Janine Juggins, who's the Executive Vice President, Global Tax and Treasury, Unilever. Our third speaker will be Yoichi Takamoto, who's General Manager, Global Tax Office, Financial and Accounting Department, Panasonic Corporation. And today, Yoichi will be representing Keidanren, which is the Japanese Business Federation. Our fourth speaker will be Simon Graddon, who's a tax director at Amazon. And lastly, but not least, Colin Garwood will be representing the Intercontinental Hotel Group. So I would like to thank everyone, the speakers today, for being part of this. Turning to the panel discussion, I'll turn to Louise Weingrod first. So Louise, in your comments, you covered a number of areas, including the concept of consumer-facing businesses, Nexus, and the formulaic calculation of Amount A. Could you share with us your most important comments on the design of Amount A, and in particular your thoughts and ideas for simplification around the marketing distributor safe harbor?
Okay, well, thank you, Matt. And I believe my first slide is going up.
Yes, Ego, will put your slide up, yep.
Okay, great. I appreciate the opportunity to participate on this Pillar 1 panel and share perspective on reducing complexity. I'm a late substitution for Catherine Amos, who unfortunately is not feeling well. Just at the outset, I want to comment that at Johnson & Johnson, we commend the OECD's Herculean leadership to forge a simple, certain, and sustainable approach to cross-border taxation for the 21st century. There's been tremendous progress to reach this point with a highly inclusive approach, evidenced today. And we're committed to multilateralism and the success of this project. And to that end, my comments are offered in the spirit of supportive collaboration. Success for Pillars 1 requires 3 elements, in our view: simplicity, certainty, and sustainability. The current draft is highly complex, with vast areas of uncertainty about both application and principle, and consequently, in our view, unlikely to be sustainable over time. One major challenge is the industry-specific approach. For example, the category of consumer-facing business is not clearly delineated or principle-based, and business segmentation further complicates its application. A second area of complexity derives from the pricing model for amount A, for example, 20% over a 10% return, which is catchy, easily understood, but not grounded in principle or replicable process, and so not sustainable over time. In addition, instability stems, as we discuss in our letter, from amount B not fully shifting from an arm's length principle approach to a formulary approach. We see the arm's length principle as the only appropriate method for pricing complex value driving activities, but it is overly complex, resource draining, and an uncertain choice for routine low value activities like low risk marketing and distribution. So we support a fully formulary approach. I'd also like to comment briefly on change management. The movement from the arm's length principle to a formulary method for marketing and distribution is a quantum leap for global taxation. To successfully manage that change for both countries and companies, we must allow time to assess, learn, and adapt. One approach to both move quickly and do that would be to position the formulary method as a safe harbor, with the arm's length principle remaining as an option for a defined time frame, with all the comparative uncertainty and administrative cost that the arm's length principle involves. I appreciate the political overtone of a safe harbor. In response, I would urge interested parties to read an excellent 2013 publication. It's titled Revised Section E on Safe Harbors in Chapter 4 of the Transfer Pricing Guidelines, published by the OECD. Back in 2013, it was less controversial to observe that safe harbors offer basic benefits. They simplify compliance and reduce compliance costs. They provide certainty to eligible taxpayers, and they permit tax administrations to redirect resources from examination of low-risk transactions to more complex high-risk transactions and taxpayers. In the interest of a successful project, I hope we can avoid the politics and objectively consider those arguments from 2013 as we approach Pillar 1. Second slide, please. Our proposal is a repositioning of Pillar 1 as a simple formula combining amounts A and B. It's even simpler than the formulas we proposed in 2019. Like the current Pillar 1, it's designed to reduce cross-border disputes and relieve the costly administrative burden of transfer pricing for routine marketing and distribution. Unlike the current Pillar 1, it offers simplicity and certainty for both countries and companies, with clear principles underlying fair administration and no mixing of arm's length principle and formulary concepts. It also offers a calculation that can be done by the OECD or designated agency using a simple, transparent, replicable process with a large data set. Starting with simplicity, if a company has low risk marketing and distribution with local nexus, it's in, full stop. That approach eliminates the politics and debates around which industries are in or out, or partially in or out of amount A. It provides a broad, inclusive definition of routine low value-added activities to ensure that we're not getting into scope issues, only excluding activities that drive residual profits. So low risk, local nexus marketing, you're in. On certainty, under our approach, which we call amount Z, there is not uncertainty about the fixed return, which is based only on a company's enterprise operating margin. So there's no separate calculations that countries or companies would need to do to determine the fixed return. This approach will remove subjectivity from the comparable company selection process, and again, free resources for countries and companies to focus on the more complex value-driving transactions. Sustainability. We anticipate that a global table of fixed returns will be published by the OECD or designated agency, and it will use a simple, transparent, replicable process with a large data set. In the example I'm about to show, which we're not wed to, we're agnostic to as long as we meet these goals, we used the global Orbis database with a 3-year view, so 2017 through 2019 is what we looked at in 2020. And we made 2 eliminations, one with companies with losses and one for companies with return on sales over 100%. This led to us including over 11,300 companies in our set. Our proposal would be that this would be updated at set intervals, perhaps every 3 years. If we go to the next slide, which is an illustration of how our proposal, which we call Amount Z, would work. Again, Amount Z would replace amounts A plus B. We developed 5 tiers of enterprise operating margin results using data we're happy to share on request. Each tier has a different return on sales target. As noted, there would be no separate calculations needed by companies or countries, as the enterprise operating margin is the only variable for the fixed return. We used the Orbit database, as I mentioned, to identify global companies using codes relating to sales, marketing, and distribution. Initially, there were over 14,000 companies in our search, and as I mentioned, we brought that down to, through some reasonable eliminations, to over 11,000. We then calculated the interquartile range of a 3-year average return on sales and used that range to calculate each tier's return based on percentile positions. To apply the method, a company would calculate its 3-year average enterprise operating margin, review the global table, and apply the corresponding return on sales to all of its marketing companies. For example, if a multinational earns an average enterprise operating margin of 17%, it would be in tier 3, and all of its marketing companies would earn 3.8%. That would seem to us to be attractive, even if it were slightly higher under arm's length principles than an arm's length principle, because of the savings on calculation, the savings on documentation costs, and the elimination of audit risk. Also, this would be the full story. I would remind you, Z would replace both A plus B. To conclude, a well-designed Pillar 1 will achieve marketing and distribution returns around the world without political preferences, creating winners, losers, and loopholes, with less administrative burden on transfer pricing for low-value routine activities. We can take a step toward liberating both countries and companies to invest resources more productively in innovation, economic investment, job creation, things in the interest of humanity. Simple and certain is also critical to the developing countries of our world who deserve their fair share of tax revenues without having to hire armies of economists and lawyers. Moreover, a simple principled model will be more likely to be sustainable over time. As we ended our letter, moving from complex to the simple is not an easy leap, but as noted by the great Eleanor Roosevelt, a little simplification would be for the first step toward rational thinking, living, I think. Thank you, Matt.
Thanks, Louise. Just a quick question from me. You mentioned the Amount Z model potentially being set up as a safe harbor. How do you attract companies into the safe harbor if the returns are potentially higher than under the arm's length principle? Does your proposal include enhanced dispute prevention or resolution? For example, to address disputes about segmentation or this being in the scope of Amount Z?
Yeah, we don't address that full on, but certainly assume that that would be a part of the program. Again, our proposal is focused on the what I described. We think the main attraction, however, would be the certainty, the elimination of all the work that goes on around setting pricing and documenting. And that as long as the results are reasonable for companies, that would be very attractive, and it would be attractive initially, but over time it would supplement, it would replace the ALP.
Thanks, Louise. Thanks very much for your presentation today, your comments, and also a response to the question. I now turn to our second panelist, Janine Juggins. And Janine, in your comments, you focused on Nexus plus factors, segmentation, and possible double counting, and how they might impact particularly decentralized business models. Could you share with us your thoughts, please, on the design of Amount A, and tell us a little more about your thoughts on the elimination of double taxation? How do you see this impacting decentralized models, and where could the complexities be reduced? Janine.
Thanks very much, Matt. A big thank you, first of all, to the OECD for the opportunity to participate in this process. Like Louise, we also support the multilateral process that's being coordinated by the OECD. We think it's the only way forward. And we also think that businesses should be making a positive contribution to the societies and environment in which they operate. So complexity really is the common enemy. It creates not only a compliance challenge for taxpayers, but also for tax administrations. And it's also a real communication challenge. So the public needs to understand that the tax system delivers fair results. Complexity is going to hinder the development of public perceptions. Are they going to think that what we're achieving here is developing a fairer result? So Unilever's an international branded consumer goods company. We're headquartered in the UK. We sell goods to consumers, but the majority of our sales are actually via other businesses, retailers and distributors. But we assume we're fully within the scope of a consumer-facing business as defined. And we already have a corporate tax presence in over 100 countries. So it would be our intention to automate compliance with Amount A as much as possible. And so for that reason, our preference would be to have a threshold test for Nexus that you can easily automate. And we think the plus factors would actually be potentially more trouble than they're worth, because any exercise of judgment inevitably opens up the potential for tax disputes. So one potential option would be to provide for a taxpayer election to not use plus factors when determining Nexus. So not all multinationals use the same operating model. And so, for example, we use a decentralized business model, which you can see on this slide here. And to describe at a high level what this means, the trademarks, brand names, and technology are owned by a central intellectual property company, an IP company, that has all the relevant functions to manage those trademarks and incur all the related costs. And I would add that this IP company is not in a low tax country. The IP company licenses the trademarks and technology to the operating companies in the marketplace, and a royalty fee is paid by those operating companies on which a withholding tax might be deducted. The operating company may manufacture, but it will sell and distribute the branded goods and have its own marketing intangible in the form of the licensed rights, the right to use those trademarks and technology that has been licensed from the IP company. So what this means is that in a decentralized business model, the residual profit attributable to the market is actually earned and taxed in the operating company. And even on the slide here, where sales are made into a third country, perhaps via a third-party distributor, it is from usually from another operating company. So in our example here, the residual profit related to the sales going into country 3 is actually being earned by the operating company in country 2. So you may then ask yourself, what about the royalty that's been paid to the IP company? isn't that a share of profit that's been earned from the market? And my response to that would be, first of all, the payment of a royalty to use a trademark and technology is a very common transaction between third parties. It's really easy or readily capable of being priced under the existing transfer pricing rules. And then secondly, where the operating company in the market country has deducted withholding tax from the royalty paid, this is a de facto exercise of the source country's taxing rights with respect to the intangible income that's been earned by the IP company. And this withholding tax can be very significant because it's based on the amount of the gross payment and not on the actual profits that are earned from the intangible income recognized in the IP company. So for these reasons, I would argue that where there's a decentralized business model, there's no principled basis on which to extend source country taxing rights further. And so this puts more emphasis on concepts such as double counting and the simplification steps already included in the consultation, such as the marketing and distribution safe harbor. But let's put these arguments to one side for a moment. And I want to take you through an example. And apologies here for the slide, but it's impossible to talk about numbers without having a slide in front of you. So I want to demonstrate to you why the issues of double counting and withholding taxes have to be considered together. So I've actually taken the scenario that's set out in box C4 from the examples in Annex C, and this is to make it easier for you to look at afterwards. This shows consolidated group sales of 12,000 arising in 4 different countries under a decentralized operating model where the operating companies are earning the market profits, but a royalty is charged by the IP company to those operating companies. And the IP company, you can see, is recognizing total royalty income of 2,000, but that's all being paid by the operating company. So in group terms, that's a zero-sum game. When you come to look at the profit before tax on an entity basis, you can see that the IP company has earned profits of 750 and therefore has a profit margin of 38%. Operating company in country 3 has profit before tax of 650 and has earned an operating margin of 33%. And looking at an aggregated basis at all the profits before tax, that comes to a group profit margin of 20%. It's important to understand that when you aggregate all these profits before tax, that is not going to come to the group profit that's shown in the financial statements. And that's because these are entity profits before tax, no consolidation adjustments have been made, and therefore it can give quite distortive results. I've also assumed that the IP company has a corporate tax rate of 25% and has suffered withholding tax of 10% on that royalty income of 2,000. So the withholding tax is 200. So if you look at the figures in red, the withholding tax suffered of 200, in fact, more than offsets the corporate tax liability of the IP company. In fact, with a 25% corporate tax rate and a withholding tax rate on royalties of 10%, the IP company actually needs to earn a minimum profit margin of 40% to fully offset the withholding tax. Now, what this example demonstrates is that if the IP company has to surrender income for amount A, it will effectively always suffer double taxation unless some adjustment is made for the withholding tax. Put simply, there is no net residence country tax for the IP company at all, due to the market taxing rights already being levied on IP company income through the market withholding taxes. Now, if for the purposes of the amount A calculation, the withholding tax were instead converted into a deduction from taxable income for the IP company, to get the same effective tax relief of 200, this would need to be tax deduction, a deduction from taxable income of 800. And as you can see, the profit before tax is only 750. So what that would mean is there is no headroom for the IP company to surrender amount A income to the operating company. And what this points to in this example is that it's actually operating company in country 3 that's going to have to be the payer for amount A. And as there is no market connection between the operating company in country 3 and the other operating companies, what that effectively means is that the amount A paid by operating company in country 3 is going to have to be allocated on some formulaic basis. And the net effect of all of that will be to average out the operating group company profit in every country. Now, a further alternative to addressing this issue of withholding tax is for the tax value of any amount A allocation to a market jurisdiction to be reduced by the amount of withholding tax that has already been collected by that market in the exercise of their source country jurisdiction taxing rights. So in conclusion, I support the comments in the paper that amount A does not seem particularly relevant when it comes to decentralized business models. The risks stemming from related party transactions seem more than capable of being addressed under the current existing transfer pricing methods. And furthermore, if these issues of double counting and withholding tax are not properly addressed, then this is going to put multinationals that operate a decentralized operating model that are arguably already paying their full share of tax in market countries at a competitive disadvantage through the risk of double taxation. And in line with the tax policy intention of amount A, where a decentralized business model is operated and the profit related to the market is already taxed in the market, our simplification suggestion would be to say that there should be a risk-based restricted scope for amount A calculations. And by this, we mean that the amount A analysis should only be required for those countries where sales are made, but where there is no operating company in that country that is reporting the residual profits. Thank you very much.
Thanks very much, Janine, for your comments, and certainly taken on board in terms of the withholding tax and impact on decentralized models as well. Just a quick question, Janine. I think you made a point around amount A sort of probably not being, shouldn't be focused on decentralized businesses, but how do we propose to exclude that? It sounds to me you're talking about a risk-based framework, which might be both quantitative and qualitative, and I wonder if that sort of line drawing exercise creates complexity in itself, but I'd be interested in your thoughts around that.
Yeah, well, I think there's possibly a role here for the panel for amount A, because as part of the presentation, the taxpayer's presentation of what it thinks its amount A due actually is, this could form part of, a first hurdle that you consider before you then go on to do your amount A calculations.
Great, thanks so much. Thank you very much, Janine, for your comments. I'll now turn to our third speaker, whom is Yoichi Takamoto. So Yoichi is representing, as I've mentioned, Keidanren, the Japanese Business Federation, of which Panasonic is a member, and Keidanren is an important voice for business in Japan. And there were three particularly vital elements for the Keidanren submission when it comes to amount A. Number one was simplification of the revenue sourcing rules. Number two was segmentation. And thirdly was the elimination of double taxation and identification of the paying entity. So Yoichi, could you share with us your most important comments on the design of amount A, and particularly on the segmentation framework, as well as revenue sourcing? I turn now to Yoichi.
Yeah, okay, Matt. Thank you for the opportunity to make comments. My name is Yoichi Takemoto from Panasonic Corporation, and today I speak on behalf of the Keidanren, the Japan Business Federation. it is important to jointly agree long-term solutions. The scope of both pillars should be narrow to respect the principle of proportionality, and the rules should be simple to minimize compliance burdens. Please look at page 1. K-Landen has identified 4 key issues to reduce complexity. The first is to simplify revenue sourcing rules for transactions through independent parties. This is the most important issue for Japanese companies, and I would like to take a deep dive afterwards. The second is to utilize existing disclosed segments. The segments currently disclosed in M&E's financial statements should be respected. Cases where the use of disclosed segments can be rebutted by tax administrations should be narrowly defined and specified in guidelines. Also, to respect the segmentation currently implemented by companies for financial reporting purpose and avoid additional burden. It is appropriate to base segmentation hallmarks on IFRS 8 rather than AIS 14. The third is to identify paying entities in a formulaic way. The determination of paying entities should ensure simplicity and contribute to tax certainty. We support a formulaic allocation such as Step 2 and 4 rather than a qualitative test. Step 3, a market connection priority test would cause concern due to the potential compliance burden. As for eliminating double taxation, we strongly recommend that individual jurisdictions uniformly adopt the exemption method. Fourth, the double counting issue should be addressed properly. The policy objective of marketing and distribution profits safe harbor is understandable. However, to make the rules useful, clarification is needed regarding how a fixed return and amount B currently interact. The fixed return should be set in a simple manner and in a low level. Furthermore, it may take significantly more time to achieve consensus on the concept of different fixed return for each industry and region. To ensure simplicity, a single fixed return would be preferable. Next slide, please. On revenue sourcing rules, the blueprint's proposal is very prescriptive and difficult to implement. It is imperative that the revisions be made, in particular with respect to transactions through third parties for the sake of simplicity. Where an M&E like Panasonic sells consumer-facing products like dry batteries or indoor air conditioners through third parties, and it is often the case that multiple independent distributors are involved in sale. It is usually impossible to obtain information on how many units of products were ultimately sold in which jurisdictions. This is because information on sales destinations, including the aggregate number and type of products sold, is sensitive commercial information for the distributors. Also, to obtain this information, additional costs such as developing IT systems need to be considered. Moreover, the hurdles to change contracts are extremely high. For some products such as household appliances, a single entity in an M&E group is engaged in transactions with hundreds of independent distributors, and the independent distributors range in size from large corporation to SMEs. Next slide, please. Based on these challenges, we believe that the following 3 points need to be considered. First, please narrow down MNEs required to apply revenue sourcing. According to the blueprint, MNEs may be required to determine the amount of revenue for each jurisdiction at the stage of de minimis falling in scope revenue test. However, taxpayers should be allowed to calculate numbers for each step as they choose regardless of the listed order from step 1 to step 10 in the process map, where the profit before tax of the relevant group or segment is less than the amount determined based on an internationally agreed routine profit margin. Any revenue sourcing exercise should be made unnecessary. This would greatly contribute to reducing the administrative burden. Second, hierarchical approach should be reconsidered. Basically, each MNE should be permitted to determine indicators depending on the availability of information and characteristics of transactions and markets. If hierarchical approach is maintained, strict rules should not be imposed regarding reasonable steps to obtain information. It is not appropriate to seek a change in the contract because it will cause a significant compliance burden for both parties. At a minimum, MNEs should be able to determine the applicability of an indicator as a whole instead of testing the indicator for each third-party distributor, filing only one document to tax administration with simple explanation such as checkbox type format. The data on market research for the purpose of management reporting may not be reliable enough for tax return filings because of the limitation of these data. Therefore, thirdly, an alternative indicator should be adopted. For CFB, the jurisdictions where independent distributors are located should be accepted as an indicator. At the very least, if an MNE grants distribution rights to the independent distributor in only one jurisdiction, the collection of information from that independent distributor should not be necessary, and the revenue to the independent distributor should be used. Thank you for your attention.
Thank you very much, Yuichi. We appreciate your comments and also the submission from Kate Unren as well. We are running a little bit behind time, so I'll turn to our next speaker, our fourth speaker, which is Simon Gradden from Amazon. So Simon, Amazon extensively commented on several features of Pillar 1, including segmentation and elimination of double taxation. However, I guess unsurprisingly, revenue sourcing featured as a very important area in the submission. So could you share with us some of Amazon's ideas as it related to revenue sourcing?
Thanks, Matt, and good afternoon, everyone. Amazon is a strong supporter of the OECD's work to achieve a consensus solution. So I'm very happy to be here today and provide input towards that goal. Amazon supports the underlying themes of the blueprint, but as the inclusive framework has self-acknowledged, some aspects are overly complex and opportunities for simplification are welcome. The rules should allow businesses to comply and enable all countries to implement in a manner that reduces disputes and prevents double taxation. The solution should be clear and practical. At the same time, uniformity of implementation is critical to avoid a disparate set of rules in each jurisdiction. As Matt said, I'll focus most of my comments today on sourcing. Towards the end, I'll also make some comments on segmentation. I will offer some suggestions for how we could simplify the solution so that it's implementable and practical for both taxpayers and tax authorities. And I'll start with sourcing. The blueprint predominantly uses place of consumption for country location sourcing purposes. We support that approach and the principles underpinning it. However, we consider that the blueprint could benefit from simplification in some areas. And in particular, those are, firstly, user location or IP address. Secondly, business-to-business transactions. And thirdly, the obligation placed on taxpayers to substantiate that information is either unavailable or unreliable. And I'll talk through each of those in turn. We note that in certain situations, sourcing is based on user location or IP address. We have concerns that this will be difficult to administer and implement. Many businesses do not collect this information, and a disproportionate amount of work in terms of changing systems would be required to do so. If, as suggested, aggregate data only is going to be provided, then it's difficult to see how tax authorities would actually audit that data. If, on the contrary, customer-specific transaction data is provided, then that could lead to data privacy concerns. Furthermore, even if that data were collected, it's likely to be inaccurate. A large proportion of internet access is through VPN, including corporate networks, which will not reflect the actual location of the user. So to give you an example, I'm talking to you today from Luxembourg, but my IP address will probably say I'm in Germany. And the reason for that is because I'm accessing through my Amazon laptop, corporate network, and the nearest data center to me is in Germany. But that shows IP address will not always give an accurate location. So it's not a good use for sourcing. In terms of business-to-business sales, the rules as currently drafted could actually impact companies who are themselves not within the scope of Pillar 1. So let me explain that. The reason for that is because in-scope companies would be required to request their business customers to provide information about their own customers and their own sales data, even though they themselves are not within the scope of Pillar 1. For valid commercial reasons, business customers are likely not to want to provide that information to the in-scope company, and that's completely reasonable and understandable. But it leaves the in-scope company with a difficult choice. How does it deal with that situation? So it could either try and impose contractual obligations on its business customers to provide that information to it. It could refuse to sell to that customer, or it could potentially be non-compliant with Pillar 1 unless it can demonstrate evidence that it's taken all reasonable steps. That places a significant administrative burden, not just on in-scope companies, but also on companies who are themselves outside the scope of Pillar 1. In terms of the evidence requirements, further clarification is needed on what those reasonable steps are and what evidence is needed to substantiate business compliance. We have concerns with how companies will achieve certainty in this area. So, for example, if you go to the review panel and additional steps are required or additional information needs to be collected, the reality is that's going to take a significant amount of time because it's likely to require you to update systems, which is often a multi-year process. For these reasons, and to promote simplicity and certainty, we suggest that the place of consumption be used for sourcing purposes, and the purchaser be defined as the first third party that pays for goods or services, and not the end consumer following on any onward sales. In addition, we would suggest that for business customers, the place of consumption follow existing VAT rules. Companies will already have that information available to them, and that means Pillar 1 can be implemented quickly and efficiently. It also reduces the need for additional systems development, and it will also reduce disputes because tax authorities will already have access to that information and already be auditing that data. I'd like to turn also to segmentation. Amazon considers that the most accurate and simplest method of segmentation is to use the global audited financial statements. Inclusion of qualitative segmentation hallmarks, that require additional segmentation will add considerable complexity. Should additional segmentation be required, taxpayers and tax authorities will have a significant challenge to prepare and verify that segmentation, as well as associated computations such as loss carry forward amounts. We would be concerned that this will take up a significant amount of time of the review panel process, and countries within the panel may themselves not agree on how to apply those hallmarks to a complex integrated business. In order to promote simplicity and certainty, we support the use of global audited financial statements. That information is readily accessible and reliable, both for taxpayers and tax authorities. In closing, we hope our suggestions for simplification help the OECD and the Inclusive Framework to come up with a solution that works for all parties. As I said at the beginning, Amazon is a strong supporter of the OECD process. Thank you.
Thanks very much, Simon. Let me just ask you a brief question, sure. Simon, if that's okay. Amazon, I guess, is not alone in wanting to source revenue based on the location of the first third-party customer.
Yep.
And one of the key concerns highlighted with the approach is that it will lead to revenue from online advertising to be sourced to the jurisdiction where the advertising is purchased, rather than where the users are. But we've also heard arguments that purchases of the advertising and the users are typically based in the same country. But I wonder if that argument still holds for smaller jurisdictions in developing countries, and if you had any thoughts around how to deal with that particular issue.
Certainly, we support the location being based on the location of the purchaser. It's much simpler. It's much more certain. I'd go back to my point about IP address and the inaccuracy. So if you take a small country, I use my example of Luxembourg and the nearest data center being Germany, IP address data will give you this largely the same. And so I'm not convinced it would be any more accurate and not lead to the same concerns. I think it's around having a solution that's certain and simple and that can be applied.
Great. Thanks very much, Simon, and appreciate your comments and Amazon's continued support of the Pillar 1 project as well. So thank you very much. Let me turn to my last panelist today. So this is our panelist number 5, Colin Garwood, who is will be speaking today around franchising models and withholding tax. So, Colin, it was interesting to read some of your feedback on how Pillar 1 might impact the hotel brand franchise business, and of particular interest were your comments on managing the risk of double counting or potential double counting. So would appreciate if you could share some of your comments from your submission, in particular the risk of double counting between amount and withholding taxes for franchise models and how we might prevent this. So I turn to Colin.
Thanks very much, Matt. Firstly, I'd like to express my thanks to the OECD for giving me this opportunity to contribute. For clarity, I'm the former head of tax of Intercontinental Hotels Group, but they've asked me to continue representing them on this digitalisation project. I don't have slides, but Janine's presentation gives a lot of the context for the issues that I'll discuss. So it's giving some background concerning Intercontinental Hotels Group. That's a hotel brand franchise business. And that type of business is an active trading business with IHG's 2019 group financial statements reflecting a profit before tax margin as a percentage of total revenues of circa 12%, after reflecting the substantial annual expenses of operating such a business and also some exceptional and financial expenses. It has a decentralized operating structure, and thus much of its taxable profits are already recognized locally in markets as domestic profits. A notable feature of the franchise business, however, is that from a franchisee jurisdiction perspective, cross-border payments of franchise fees are typically viewed as royalties and are often subject to revenue-based withholding taxes. Thus, not only the direct existing market taxation of domestically recognized franchise profits, but also this existing cross-border allocation of taxing rights to market jurisdiction via withholding taxes result in significant existing market taxing rights before considering new amount A charges. My main concern, therefore, is the issue of double counting and double taxation in market jurisdictions. both that arising from existing market taxation of local entrepreneurs and that resulting from withholding taxes applied to cross-border payments. To that end, I'll touch on the main Chapter 7 mechanism, but will then focus on what is the best mechanism for relieving withholding tax-related double counting, how that best fits with the Chapter 7 mechanism, and on whether any limitations should apply to that withholding tax-related relief. It first makes sense, however, to summarise the main categories of double taxation in both market jurisdictions and in residence jurisdictions. And I think it's important to emphasise that double taxation in both jurisdictions needs to be addressed, rather than I think there's a lot of focus on relief in resident jurisdictions. And so, as I say, to summarise the main categories of double taxation which would need to be addressed as a result of the introduction of Amount A charges. So the first such category is double taxation arising in the market jurisdiction as a result of Amount A duplicating existing profit-based taxation of the relevant proportion of consolidated profits. That concerns the issue of existing domestic entrepreneurs, which I touched on and which Janine also touched on. The second category concerns further double taxation in the market jurisdiction associated with the application of withholding taxes to cross-border transactions. The final generic category is the need for corresponding adjustments to prevent double taxation in the relevant resident jurisdictions as a result of new cross-border allocations of taxing rights via the Amount A mechanism. The main Chapter 7 double tax relief mechanism focuses on the third of these items, that is the relief for double taxation in the resident jurisdiction as a result of cross-border allocations of Amount A taxable profits. It is, however, assumed that the first issue of double taxation of domestic entrepreneurs will be addressed in passing by a process of netting down of domestically allocated Amount A taxable profits with existing domestic taxable profits. Chapter 7 does not currently include any mechanism for dealing with withholding tax-related double counting in the market jurisdiction. And so the question is how best to supplement or complement the Chapter 7 mechanism so as to deal with that. I first note, however, that the existing Chapter 7 mechanism is both overly complex and cannot be relied upon to achieve the desired netting down to eliminate the first category of double counting associated with existing domestic entrepreneurs. That is because it uses a different aggregate profit figure from Amount A, i.e. it uses consolidated profits before consolidation pack adjustments rather than consolidated profits after them, as is used for Amount A. And also because it uses a different allocation key for allocating those aggregate profits, i.e. it uses a constituent entity profit allocation key rather than a revenue key. And as set out in our submission and also that of the CBI, we believe that a simpler and better mechanism is possible which uses the same consolidated profit figure as Amount A, then makes a comparative allocation using a more traditional destination revenue key rather than the new source revenue key used for Amount A. And to briefly explain, by destination revenue, I essentially mean external revenues plus or minus net intragroup revenues, which arrives at an equivalent allocation of consolidated revenues, but using a destination key rather than the source key. As noted, however, both the current Chapter 7 mechanism and our proposed alternative focus on comparative allocations of assumed taxable profits, whereas withholding taxes concerns a tax amount. We therefore believe that trying to incorporate withholding tax relief directly into the Chapter 7 mechanism, for example by grossing up withholding tax figures, would be both overly complicated and liable to disrupt the more general operation of that mechanism. Better approach is perhaps therefore to give credit for withholding tax arising in the market jurisdiction against Amount A related tax otherwise due in that market. In principle, that would be the Amount A tax due after the prior application of the Chapter 7 mechanism, although as a practical matter, the Chapter 7 mechanism may sometimes be irrelevant if there are large amounts of creditable withholding tax. I therefore suggest that in principle, the Chapter 7 mechanism is first applied in order to net down domestic entrepreneur profits, and then withholding tax credits are available against Amount A tax liabilities which would otherwise be due. There should, however, be flexibility so that as a practical matter, Chapter 7 need not be used if withholding tax credits would fully eliminate Amount A liabilities anyway. I also note in passing that I recommend that in the first instance, a jurisdictional approach is used for both Chapter 7 and this withholding tax credit, rather than an entity-by-entity one, with subsequent allocation between individual entities being dealt with separately, perhaps as a domestic measure under some general principles. That provides relief for double taxation in the market jurisdiction. Corresponding adjustment would, however, still be needed in the resident jurisdiction in order to prevent double relief being given for the same withholding tax amount against both Amount A in the market jurisdiction and regular tax liabilities in the resident jurisdiction. That might be achieved, for example, by reducing the amount of withholding tax creditable in the resident jurisdiction by the amount of withholding tax credited against Amount A in the market jurisdiction. So that addresses the issue concerning the best mechanism for dealing with withholding tax related double counting, i.e. a credit in the market jurisdiction against Amount A liabilities otherwise due. The question then perhaps might arise concerning whether there are any reasons for limiting such withholding tax credits in the market jurisdiction. For example, because of a view that not all such withholding tax relates to relevant Amount A residual profits, or because there are other payments made from the market which are not subject to withholding taxes. I do not believe that there should be any such limits on withholding tax credits, subject only to all the local payments concerned being part of the same consolidated business from an Amount A segmentation perspective, i.e. that they do not concern such materially different business lines that Amount A itself would be computed on a segmented business line basis. I'll briefly comment concerning the arguments against limitation and then conclude. First, considering the argument that not all withholding tax may relate to relevant Amount A residual profits, for example, that some of it should be attributed to routine returns or to trade intangible related returns. Considering this point requires some principles for ordering what underlying activities withholding taxes on royalties should be attributed to. There's perhaps a primary conceptual point, however, that royalties are for the use of intangibles and thus relate to a residual profit. More broadly, however, one must surely follow the Amount A allocation principles for ordering the returns that withholding taxes relate to, i.e. that withholding taxes should be identified as first coming from the returns which Amount A allocates to the market, and only then from returns which Amount A attributes to the resident jurisdiction. More generally, there's a practical mathematical aspect to consider, which Janine also illustrated. So that, for example, a 5% gross withholding on revenues earning a 20% profit margin itself equates to a 25% effective tax rate. And so you're in circumstances where withholding taxes will often already be allocating all associated taxing rights to the market jurisdiction before any additional Amount A charges. And that is particularly so both for active businesses such as intercontinentals, and also given that withholding tax will often be higher than 5%. Janine used the 10% rate, which is perhaps more indicative. Indeed, that problem is reflected in the fact that irrecoverable withholding taxes in resident jurisdictions is frequently a significant problem already, and that is even before further exacerbation by the various Amount A processes and mechanisms, including the relief mechanism itself. Accordingly, it seems clear that no limitation is justifiable by reference to the nature of the returns that royalty withholding taxes relate to. Finally, considering the argument that market withholding tax credits against market Amount A liabilities should be effectively ring-fenced and limited by reference to the existence of other local fee streams which are not subject to withholding taxes. I note that if all those fees relate to the same consolidated business model, then that would essentially mean that market jurisdictions would keep any withholding tax related overtaxation of one fee stream, while also claiming additional Amount A tax on another fee stream, which contributes to the same consolidated profits. For example, for hotel franchise businesses, such other fees or assessments mainly represent assessments under not for independent profit funding arrangements for collective marketing programs organised on behalf of franchisees, and which activities form part of the franchise bundle. Considering the position in the corresponding resident jurisdiction, applying Amount A, or indeed applying withholding taxes on those assessments, would translate to additional irrecoverable tax credits in the resident jurisdiction, and would thus indirectly represent additional tax and double tax on the already tax franchise activities. And Janine illustrated a similar point. Market limitations on crediting withholding tax against Amount A liabilities in the same jurisdiction thus do not seem justifiable from this perspective either. In summary, therefore, the main Chapter 7 mechanism should be simplified and improved by using a destination revenue-based approach rather than a constituent entity-based profitability allocation. I suggest that this is also operated on a jurisdictional basis rather than an entity-by-entity one. This should be supplemented by an additional mechanism to allow withholding taxes borne in a market to be credited against Amount A tax liabilities otherwise due for that market, and that ability to credit market withholding taxes through a reduced Amount A due in the same market should not be ring-fenced or otherwise limited. Thank you very much.
Great, thanks very much, Colin, and thank you to all the speakers. What we'll do now is we'll turn to seek reaction from the floor, from our discussants, in terms of what they've heard from the panel and any comments that they would like to provide around that and their own views. So first of all, I'd like to ask Lisa Wadlin, who's the Vice President Global Tax from Netflix. Lisa, how would you react to the sort of simplifications that have been discussed and any other additional comments that you would like to add to that?
Again, thank you to the OECD for our opportunity to share our views and really applaud the tremendous efforts that are being spent in trying to revamp the international tax system. I think some of our themes that I'd like to talk about are consistent with what some of the other panelists, specifically Louise from J&J, has brought up in terms of really looking at potential formulary approaches for simplicity, and also some of the other panels talking about the urging of the
I think Netflix has gone down. There you are, Lisa. Yeah, you are.
Okay, sorry about that. The joys of working from home. But the results really do need to be fair, reasonable, and administratively simple in order for it to really be viewed as a win, and that the contributions of what value is being created really does need to be specific to the participants in the value chain of any particular company. We also think that an international tax system has to be grounded in clear objective principles, and that we have to have a clear understanding of the problem we're trying to solve, as well as the magnitude. We also oppose the proliferation of unilateral measures. And we certainly do not oppose the introduction of new taxing rights, but we are very concerned about the fact that the blueprints for Pillar 1 and Pillar 2, as they're currently drafted, remain overly complex and will be challenging for taxpayers to implement and for tax administrations to administer. So we would highly recommend the reduction of technical complexities and increasing the ease of administration. We do believe those need to be stressed as ultimate goals of the work being done here. The whole economy is digitizing. The OECD, through its own work, has acknowledged that it is difficult, if not impossible, to ring fence the digital economy. We do acknowledge that the scope of Amount A is one of the most fundamental elements in Pillar 1, and it can only be resolved through political agreement by the members of the Inclusive Framework. The political considerations, in our opinion, are showing up in how things have been reflected in the scope currently, with the overly broad definition of the digital economy and the attempts to ring fence consumer-facing business. The further ring fencing of the analyzing of positive and negative evidence of whether a business may qualify as an automated digital service or ADS or consumer-facing business of CFB also is overly complex in our opinion and subjective, thus leading to additional disputes and administrative burdens, again, on both taxpayers and tax administrations. As an alternative, we would respectfully recommend relying primarily on objective financial metrics, such as global consolidated turnover or revenue, group operating profit or margin, and in-country revenue, all with minimum thresholds. We do not believe Amount A scope should be defined by reference to ADS and CFB. We believe that should remove the subjectivity and hopefully avoid additional ring fencing that we see happening potentially in the scope. We would also support a phased approach under the new system. If the Inclusive Framework would continue to pursue applying Amount A using the definitions as currently drafted for ADS and CFB, we do not agree that digital content streaming should be considered an ADS business. We believe that the overly broad definition of ADS businesses goes well beyond the traditional scope of activities that are currently targeted with digital services taxes. And we do believe that to treat the streaming or digital downloading of content of ADS would be to over-index on a particular method of delivery of that content. Generally, unlike other ADS activities, streaming businesses do not monetize user data. Therefore, we see no reason to ring fence and treat differently digital content streaming from other similarly situated companies. We do believe that we are more akin to the online sale of goods and services. And so to do that, we believe that any rules that would specifically be adopted for CFBs
I'll wait just for a second for Lisa to come back. There you are.
Sorry about that.
Maybe Lisa, you could turn the video off so that
Yep, I'll turn the video off.
It's quite ironical that it falls on Netflix to have such a problem of streamline, but that's fine.
It is, and I'm not fighting with my kids for Wi-Fi, so I thought I would be okay. But I'll just conclude then to say again, we support the introduction of a new taxing right. We do believe that needs to be contingent on objective financial metrics. However, should Amount A still continue to be defined through ADS and CFB definitions that are currently in scope, we do believe that digital content streaming should be considered CFB. Again, would like to certainly thank the OECD and their opportunity to comment today, and we look forward to continuing to participate in the process. Thank you, Matt.
Thank you very much, Lisa. Appreciate your comments. Let me now turn to our second discussant, Barbara Angus, who is the Global Tax Policy Leader at EY, and Barbara will provide some brief comments as well. Barbara.
Thank you, Matt. I, for the first time since we began this new work from home era, have completely lost the internet in my home. I found a backup, but I don't know how stable it is, so I'm going to keep the camera off. So I apologize for appearing like I'm a hidden witness. But thank the OECD for hosting this virtual consultation to discuss stakeholder comments. And thank you also to all the Inclusive Framework member jurisdiction delegates for participating today. EY appreciates the opportunity to share some perspectives on this important topic. I'm going to focus on some ideas for better alignment of the design of Pillar 2 with the policy intention, reducing complexity and reducing the potential for double tax that I think have not been covered yet on this panel, although I disappeared for a few moments, so my apologies if I repeat anything. I will keep these remarks really brief, though. We believe that a domestic business carve-out would build on the concepts reflected in the de minimis foreign business exclusion and the marketing and distribution safe harbor by taking out of scope Amount A any entities within a multinational group that have activities that are entirely or almost entirely local. This approach would prevent the double counting that would otherwise occur if domestic activities for the domestic market are covered by Amount A, and would do so in a way that would be a significant simplification for businesses and tax administrations alike. Just as the de minimis foreign business exclusion provides a carve-out for M&Es whose revenue is largely domestic, this approach would provide a carve-out for those entities within an M&E group whose activities at the entity level are largely local, with revenues generated from in-country sales to local customers and residual profits taxed locally. This would be simpler, a carve-out would be much simpler than the steps that would be required to apply the marketing and distribution safe harbor to these local for local entities. This carve-out also would more fully address the double counting issue that arises when Amount A allocates profits to a market where profits are already taxed, than does the safe harbor approach, which doesn't completely eliminate that double counting. Under this approach, any local for local entities in the group would be excluded from Amount A, whether they make profits or losses. Therefore, profitable local for local entities would not be potential surrender entities for jurisdictions with losses from unrelated activities. Finally, a carve-out for these domestic business entities would mean that the local country wouldn't experience a reduction in revenues simply because such an entity happens to be acquired by an M&E group where there's no change in the entity's operations. We also believe that the proposed marketing and distribution safe harbor serves an important function in situations where the domestic business carve-out we propose would not be applicable. We do think that the safe harbor could or should be enhanced by broadening it to apply to ADS activities as well as CFB activities. The same double counting potential exists for ADS activities, and there's no reason for limiting the application of the safe harbor. Just one final point, another area where we think a simplified approach would significantly improve the effectiveness of the rules related to Amount A is in the area of double tax relief. We strongly believe that elimination of double taxation with respect to Amount A absolutely requires specific application of 100% exemption without any reduction for expense allocation rules, regardless of what mechanism the country otherwise uses for double tax relief. Any mechanism other than a full 100% exemption simply wouldn't ensure full and appropriate relief from double taxation. Thank you for the opportunity to discuss these comments. I appreciate the chance to be here.
Thanks, Barbara. Appreciate your comments around the marketing distributor safe harbor as well as the domestic to domestic exemption. Lastly, let me turn to Tom Rosa, who's the Tax Policy Counsel for Microsoft, and I'll ask Tom to make provide some brief comments as well. Thank you.
Hi, Matt. Thank you for the opportunity to provide our perspective over the next 4 or 5 minutes. While many key political and technical issues must be resolved, we support efforts to negotiate a sustainable binding agreement based on taxing net income. We applaud the inclusive frameworks focused in the blueprints on reducing complexity. As the OECD and others have observed in various contexts, complexity increases costs, reduces certainty, undermines stability of the system, and interferes with growth. The blueprint guidance is often not clear in our view on the principles informing the proposed rules. Simplification, while an important objective, is not a principle and should not automatically, in our view, override the proper application of existing tax principles that are still relevant to the Pillar 1 computations. Complexity also interferes with the ability to achieve consensus. We are concerned that the Pillar 1 blueprint is overly complex and suggest refocusing and limiting amount A to allocate to market jurisdictions an appropriate operating margin percentage based on empirical data of the multinationals' remote sales to third parties booked outside of market, with a commensurate reduction in income allocated to surrender states. Focusing on multinationals' remote sales booked outside of market eliminates complexity and disputes relating to the determination of consumer-facing businesses versus automated digital services, which is an issue that other panelists have mentioned. And this would further broaden the base. In our view, amount A must include a ceiling for reallocation to markets where the multinational already has a physical presence, and additional profits should not be reallocated to the market if the market is already being compensated at or above the OECD agreed amount. It is important to address the double counting issues. We offer two possible approaches to the market and distribution safe harbor proposal. One approach would be to compare the value-added marketing and distribution fixed return, amount B, to the profit already allocated to the marketing and distribution function under the arm's length principle. If the current arm's length principle allocation exceeds the marketing and distribution fixed return, then the excess would reduce or eliminate the additional amount A allocation. The second approach would limit marketing and distribution profits in the jurisdiction to no more than the sum of the amount B fixed return allocation for the local market jurisdiction affiliate PE and the multinational group's amount A formulaic reallocation. If the arm's length allocation is less, then there would be a top-up. If the arm's length principal allocation is equal or more, then no additional amount A reallocation would be required, and the existing allocation would be adjusted to eliminate the excess. These approaches depend on an amount B, which would introduce additional complexity and controversy. If there is no amount B, then a simple appropriate cap on amount A would simplify the process. If ADS remains in scope, we question the rationale for the recent inclusion of cloud services in the definition of ADS. Cloud computing services are back office business productivity tools and neither satisfy the stated justification for amount A nor fit within the criteria for inclusion in amount A. In addition, cloud service providers have significant scale and mass. With regard to amount B, we commissioned KPMG to conduct a fact-based economic analysis, which is attached to our comments. KPMG's economic analysis finds that regardless of industry, geography, or profitability of the companies, the arm's length return for sales, marketing, and distribution activities are within a fairly narrow band, a median of 2.5% for LRDs and 3.6% for value-added sales, marketing, and distribution activities. Amount B will not provide any certainty if the fixed percentage is too low and market jurisdictions revert to asserting that additional revenue is due to the jurisdiction because of additional functions beyond the amount B scope performed by the local market affiliate. While we support inclusion of an amount B fixed baseline marketing and distribution return consistent with the arm's length principle, if it is too difficult to reach political agreement on the amount B rules within the desired timeline, then we suggest focusing on concluding an amount A agreement. I would note that we disagree with some new comments suggesting ADS businesses obtain value from market countries while others do not, or that amount A should be limited to ADS or businesses with scale without mass, while other quote-unquote traditional businesses have different rules. These proposals appear to, in our view, to lack certainty, are divorced from the arm's length principle, discriminate based on business models, fail to relieve double taxation, and are unclear regarding how they would operate with existing rules. With regard to some of the comments made earlier, the notions relating to, the challenges relating to withholding taxes and also revenue sourcing are definitely issues that we agree with. Once again, thank you for the opportunity to provide our views.
Thank you very much, Tom. Just before we close, I'd like to turn to the panelists one more time to see if there are any reactions from the panelists, Louise, Janine, Yoichi, Simon, Colin, from any of the comments from the discussants, or any other final comments before we finish.
This is Louise. I would just observe that there's remarkable alignment around the principles of the path forward, and I hope that will be very helpful as we head toward the next draft.
Yes, thanks for that, Matt. Colin, I strongly agreed with Barbara's comments. I just note that the destination revenue-based approach, which we've outlined, I believe that gives a clear concept, or enables a clear concept to be developed as to what domestic means, in terms of domestic, destination revenue and source revenue being the same. And so I think that can help the development of such a domestic exemption, and not just one which is, a purely completely ring-fenced domestic business which has no international interactions. Thanks for that.
And if I can just add something, I think the challenge with all of this is you're not going to get significant complexity reduction unless you're also prepared to take a risk-based approach. So I think that's the trade-off really, and the challenge, how to square that at an acceptable level.
Yeah, and from my side, Matt, I think a lot of constructive input, which I agreed with a lot of the speakers on that, and ultimately the overall theme of simplicity and certainty, and getting something that's practical that can be implemented, that works for all countries and all taxpayers. So that's from my side.
Thank you very much, OECD. These comments or opinion will be helpful for the reduction of the complexity. Thank you very much.
Thank you very much to the panelists. Unfortunately, we do not have time to take any further comments from questions from the floor. However, my colleague Eric Robert has been collating all the questions, and we will respond and be in touch in relation to those questions as well. So we thank you very much for entering those in the chat function, and we will be back in touch with you. With that, I would like to thank all the speakers, Louise, Janine, Yoichi, Simon, Colin, for your input and your time today, and your very insightful comments, as well as the discussants as well, Lisa, Barbara and Tom. So thank you for spending the time on this panel in relation to the issue of simplifying some of the features of Pillar 1. And obviously this remains a key priority for the Inclusive Framework over the next few months. These comments and those that have been received as part of the broader public consultation will certainly be very helpful for the Inclusive Framework members to further explore the different options to simplify the pillar that have been discussed today. And with that, I will hand back to the chair.
Thank you, Matt, and I'd also like to thank all panelists, and of course also you, Matt, for moderating this very interesting panel. We now move to the next top item for today, which is on tax certainty and administration, and it will be Achim who moderates the second panel. Achim, please.
Thank you, Martin. Yes, and congratulations on the first panel. You're exactly on time, 2 minutes. We'll try to do the same and make it interesting and insightful all at the same time, and brief and focused and succinct. And in that spirit, this panel is a panel that covers issues related to tax certainty, Amount B, also tax administration, and of course, given the many speakers that we have and the many interventions that they have, we will not slavishly try to be tied to that. So we will be covering related aspects as well, but everyone will have a focus. We try to select to give a bit of a sense of the different flavors that has come through the public consultation. So with that, we briefly introduce the panel. We have McDonald, who is from Procter & Gamble, VP Global Taxes, doesn't need much of an introduction, I'm sure. We have Sajid Madhur, a tax advisor, this time acting for NASSCOM, which is the National Association of Software and Services Company in India, and he is a partner at Deloitte. We have Francois Chadwick, many of you know him too as well, from Uber, the VP Tax and Accounting. We have Susana Ruiz Rodriguez from Oxfam and the Tax Justice Policy Lead for a perspective on these questions and broader questions from the perspective of civil society. And last not least, on the panelists, we have Isabel Verder-Linden, who's with PwC, Global Head of TP Services. I will then also, just to be complete, we have a number of discussants, as you see, Alison Loeb from Deloitte, we have Elseline Zelle from Booking, and we also have Christopher Gentile from Verizon, where he's the Vice President of Global Tax Planning. So that is the panelists and the discussants. I think the idea that we had is that we start with you, Tim, and I think the idea was that you would give your thoughts on tax certainty, where you have extensive experience, of course, the various dimensions of that as you see them in the pillar, around the different elements. And of course, a bit like Louise at the beginning of the previous panel, there's also a proposal that you have that gives us, if you wish, a reinvented amount B, but by reassembling and putting together in a different and interesting form the different components of Pillar 1. So the floor is yours, Tim.
Well, thank you, and thanks for the opportunity to speak to this group. It's easy to look at these documents and conclude that there's still things that need refinement or parts that probably have better policy improvements. But I'm an optimist, and I look at this project and I see substantial progress, and the building blocks for success, I think, are there. Driven from these building blocks, Aki mentioned tax certainty. It's an absolute essential component for revenue surrendering jurisdictions, which are not just investment hubs, but export countries, resident countries with multinationals with substantial IP, as well as taxpayers who incur a fair amount of administrative expense for this new regime. The only thing that you get out of it is a better tax certainty and a promise for elimination of double taxation. That's a critical element for a win-win for all participants in this process. I'll address two simplification and administrative, if you could move to the next slide. Yeah, two administrative improvements to the project. I'd also add whatever comes out of this project needs to be grounded in sound tax economic policy, because the world keeps moving, business models evolve. There are going to be challenges in the future as to how to interpret this, and we need a policy guidance so that we know how to interpret new things in the future, and it will make the system much more stable. Lastly, horizontal equity is an important component of tax policy. You need to treat similar taxpayers similarly, and in the case of the original DST, that was one of the motivations, however some I viewed as flawed, to equalize the playing field versus solely domestic. I think the current blueprint has made a good effort at trying to reach horizontal equity, but there's more need for improvement, which leads to our repackaging of the proposal and the concepts. I think if you could go to the next slide. This will quickly just illustrate the need for segmentation. Some have argued maybe segmentation is too complex. I believe for both political and policy reasons, you need to have a taxpayer elective option to do segmentation, either on product line or on a regional basis. And the reason it's illustrative in this table, if you look to the top half executes amount A calculation just as the blueprint suggests. You'll note in column 5, there's an incremental 3% of sales attributable to the market jurisdiction or amount A, but it's even across all markets, despite the disparity of income as shown in column 2. Segment 1, whether it's region or product line, has almost a 40% operating profit. Segment 2 is kind of at the average, almost, of 21%. And segment 3. Segment 2 is at the bottom. Well, it doesn't really make sense if your supply chains are not global to have this kind of an outcome. It produces the risk of a political challenge that arguments could be made that solely domestic income is being reallocated to other regions without a rational nexus. If that's the basis, this project will fail. If you look at the alternative, which is in the bottom half of the table, the segmentation goes based on the profits of each segment and proportionately shares residual profit based on the economics of that region. The reason this is important is some companies have global supply chains. Tech, digital, and pharma classically could make a product from a single plant and serve the world because they have very high gross margin, they have very low logistics cost, and they can scale a facility. So that looks to a global solution. It may be rational for them to actually use global financials. But in the consumer products industry, regional logistics and warehousing is a larger cost for us and for most consumer-facing companies than the actual cost to make the good. We have to be regional. And the externalities of the region, whether it's higher logistics costs or other dynamics of the market, they dictate the profitability on a regional basis. And it's quite common to see the unevenness of profitability in our business on a regional basis, as indicated in the top half of the screen. So if we could go to the next slide, I'm also going to talk to horizontal equity considerations. The current blueprint, and I'll just focus your attention on the gray line of both the top and the bottom. The blueprint as proposed for an average profitability of 12% allocates for a traditional business model, a consumer-facing or one with a taxable presence that has amount A. They have both an amount A and an arm's length amount B. That amount of total return to the market produces 24% of their total system profit going to the market. A similar business that's scale without mass has a fraction of that. It's 0.4%. What that means is there's over a 7 times differential in this example for an average profitably enterprise. How much is going to the destination market? Now, as profitability rises, these differences converge, but they never meet. So even at the extreme levels of profitability of 40%, which is a phenom level for most companies, there's still almost 1.5 time differential. That doesn't look like horizontal equity. The proposal that we have, which I'll mention in a minute, is represented in the bottom half of this chart, and it has a different way to account amount A and amount B, but it also addresses simplification issues. Our current definition of amount A is tethered to both a definition of consumer-facing and ADS, and by implication also excluded industries where they may have consumer-facing components within the industry. These definitional disagreements and ambiguities create policy pressure points. They create political pressure points. As we've heard in prior testimony, many companies argue that their company should be excluded. This is not a stable way to design the system. Equally, the policy rationale, the theory for why to include some and others, has a concern. It seems to stigmatize. It seems to, in effect, be a different type, a bigger ring fence. And it also disproportionately affects some. As I indicate, you could make these converge closer with a modified approach, but fundamentally, to simplify the process, our proposal is to reimagine amount A and B. In amount, what we suggest is let's make the definition very clear. You're either a taxable presence, which we call traditional business model, or you're someone that does not have physical presence under a PE type concept, in which case you'd be a scale without mass. In those circumstances, we think you should have one calculation. Your business model in a country is either this revised amount A or revised amount B based on whether you're physically there. If you take this approach, you need to address the concept of, well, what happened to the reallocation of jurisdictional taxing rights? in our proposal, which if you go to the next slide, we embed that in the calculation of amount B. For those that have a taxable presence, we added 2 features, well, actually 3 features that are a departure from the current practice art of transfer pricing to calculate a distributor return. OECD guidance currently allows distributors to have a loss. We've talked to many developing countries, and they have many, many taxpayers who have long histories of local distributor losses. It's difficult for them to challenge these. They're having trouble collecting even a basic minimum amount of return. What we concluded is that with the exception of a well-documented local entrepreneur, a global enterprise is, particularly those that are within the scope of this project, they are globally scaled to some extent. Therefore, someone is an entrepreneur making the decision to enter that market and incur losses to establish a future business. That probably should not be borne by the local market. So we suggested a 1% of sales is the minimum return. That's illustrative. The concept is there would be a minimum income floor for all distributors except a purely well-documented local distributor. We then produced a range that looks very, very highly correlated to arm's length results. It's a range that is 20% of system profits. It's much easier to calculate than a transfer price study. As I've noted in other testimony, 2/3 of the Inclusive Framework countries do not have an economist or a licensed database to execute the practiced art of transfer pricing. We need to address this. We need to have a method that everyone can easily calculate. This will help solve it. And it actually would produce a very similar amount. So these 20% ranges would produce a distributor return equivalent as a percentage of sales of 1 and 2.5%, which is what many studies would suggest is highly correlated. Lastly, there is income participation for those that are above average returns. We indicate the difference between the blue line, which is your classic arm's length result fixed commission, where third parties do not participate in an enterprise's excess returns, versus a participation, as we suggested in our formula, that would produce a sharing at the higher levels of profitability. For taxpayers in a particular country that have a taxable presence, this is the exclusive calculation for what they owe. It's very similar to J&J's concept. For those that are scale without mass, I'm not an expert in that area. I'm not going to be prescriptive. You could have a system that says it's a modification of amount A as envisioned in the blueprint. Alternatively, you could have a system that says perhaps we have, with a certain level of sales threshold and a certain amount of externalities like advertising, and I importantly would add the absence of a local distributor or counterparty that's a taxpayer, whether they're related or unrelated. So what I'm describing is like direct to the end consumer. If those criteria are met, this revised amount A would apply, and maybe it's a deemed PE and a formulaic income attributable. Maybe it's the amount A is envisioned in the blueprint. I think the important thing is, however it's calculated, it should have some proportionality to horizontal equity considerations, both as to solely domestic enterprises that are competing, as well as the traditional business model expectation for returns. It is important that in this concept, if we are trying to stabilize the system and we're trying to enhance tax certainty, all those that participate, all of those that are participating should be participants in the benefits of the certainty. They need to partially pay for the piece themselves. So excluding industries, in my view, is problematic and creating complexity. And with that, I will cede the time.
Thank you, Tim. Very inspiring. Thanks for those words. And it was, as some were questioning, a broad interpretation of tax certainty, but nevertheless a very useful contribution, also linking it to what we heard earlier from Johnson & Johnson with somewhat similar concept in the B space, but adding an A to the B. I think after this, I'll quickly move on to our next panelist, who is Sujint, and I am certainly mispronouncing your name, for which I apologize, who's speaking, as I said, on behalf of NASSCOM, an Indian business association. And I think, you know, there's a lot of useful insights in their contribution relating to the Amount A process, how this could be structured, how it could be improved. And I think you will also be reflecting on the Indian experience in dispute prevention, resolution, and how we can learn from that as we build into the future. The floor is yours.
Thank you, Akim, and thank you. Appreciate the opportunity. On behalf of NASSCOM, I'd like to thank the OECD for including us in the process of policy making towards the building of a consensus for the digital economy. At the outset, I do have a set of slides which I've sent in separately, but I will keep this contained to the speech. To begin with, it's useful to take a look at the Indian experience with tax certainty and administration. When we look at the concept of advanced certainty, the advanced certainty in India is obtained through two processes. One is in relation to an advanced pricing agreement, which is for transfer pricing, and the other is for the use of the authority for advanced rulings, which is on matters of tax other than transfer pricing. From a transfer pricing standpoint, there have been about 300 APAs that have been signed till about 2020, from 2013 when the program was introduced, of which 31 are bilateral and one is seeing an uptick in the bilateral application process. From a dispute resolution standpoint, there are two processes. There is the mutual agreement procedure and there are tribunals and courts. And if we look to the mutual agreement procedure, there are about 75 MAP cases that get resolved every year, and it takes on average about 3 years to conclude a MAP matter. Now it's useful to look at what the view is and the experience is of the Indian industry when you look to the processes for advanced certainty in India. And clearly, one of the outcomes is that the APA program has been progressing well and has now been extended to bilateral APAs. It's been witnessing an uptick, especially after the MLI. The bilateral MAP experience has also been good, but is limited to alleviating double tax. And then the AAR program, the Authority for Advanced Rulings, which is a quasi-judicial body, as opposed to the consensual process involved in a APA process, has bandwidth constraints and is time-consuming, such that results are well after the transaction, but more importantly, it is subject to further appeal and therefore could be litigative. Now, on the basis of this backdrop, it's useful to then look at what are the learnings and recommendations that arise in relation to the early certainty process and the dispute resolution processes concerning Amount A and later on Amount B. The first and most important aspect is that businesses require a constructive approach, which is to say understanding the business, working towards resolution, and timeliness, which is to say time-bound certainty. These are two key expectations from business, and therefore the dispute prevention process needs to be oriented to address both of these requirements. The panel approach, which is review and determination proposed in Pillar 1, appears to be reasonable in this context. The mutual agreement procedure experience is that tax administrations can resolve disputes, and therefore panels of multi-country tax administrations can be effective in this connection. The objective is to obtain certainty for companies on where they should pay taxes and how much. And that's what the process of dispute prevention and tax certainty is seeking to achieve. And to this extent, tax arbitrage is not on the mind and is not on the radar. And therefore, once certainty is obtained, it can be for a number of years. Coming to the aspect of the determination panel, this is intended to be used to, let's say, break any deadlock or handle any deadlock that could arise in terms of review. And therefore, this can be addressed, or the determination panel can be comprised of a group of tax administrators independent of the review panel. Officials from the competent authority, as we have noticed in the context of MAP negotiations, are equipped to handle such matters. It is the plea of the industry for the inclusion of technical experts from industry in an advisory panel that will serve as a standing adjunct to the review panel and the determination panel. So to be clear, the review and determination panels will comprise tax administrators, and the expert panel will be providing necessary inputs, advice, and information based on which the review and determination panels can make an informed judgment. There is, for instance, a need for improved certainty on the scope of ADS, particularly in the context of certain automated services in cloud computing and revenue sourcing rules. And this is where the role of the experts or the panel of experts can be very useful. It should be noted that the early certainty process should be applicable only to the new taxing right, which is amount A, for the reason that amount B is based on arm's length principle, and so also issues arising out of amounts beyond amount A are also subject to transfer pricing regulations, and therefore these amounts either of B or beyond amount A should be subject to bilateral agreements or should be subject to a mutual agreement procedure. And to this extent, therefore, amount A should be, the early certainty process should be restricted to amount A. From a resource perspective, the blueprint anticipates that a significant majority of in-scope M&Es will participate in the early certainty process for the first years following the introduction of the agreed rules. In this regard, the blueprint should address how countries may set aside sufficient resources, and this is an example that one can borrow particularly from India when the advanced pricing agreements were introduced and there were a slew of applications that were filed, and therefore sufficient resources need to be provided for to deal with the applications in an expeditious manner. And again, when such applications are pending, countries should suspend the application of domestic tax compliance activities, including audits that may impact the amount of the determination of amount A. From businesses' perspective, there may be good and valid reasons why M&Es choose not to apply for early tax certainty, and they should not be prejudiced from doing so. Therefore, the blueprint should make clear that dispute resolution under the MAP process in international treaties remains available to all taxpayers, regardless of whether an early tax certainty application was made. The blueprint suggests that it will be possible for the M&E group to disagree with the recommendations of the review and determination panel. And in that case, while it is not exactly clear how the M&E group can look to domestic procedures of each jurisdiction, it is necessary to examine this issue in greater detail with a view to particularly avoiding double taxation and keeping in mind a multi-country perspective. Finally, from a development and administration point of view, and this is a recommendation, as it were, for a holistic approach to development around the knowledge of the digital economy, the new regime should promote studies to develop better understanding of user activities in various jurisdictions. For example, to examine the economic nexus due to user activity in key market jurisdictions. Studies could be conducted to understand user contribution, the value of data as an input to business, the value of users as an aspect of demand creation, or the real or creating the market, and the real indicators of participation of an enterprise in the economic life of a market for the purpose of designing tax policies. And with that, I come to the end of my presentation. Thank you very much. Over to you, Kim.
Thank you very much for this very insightful, very helpful comments, and to what you had also submitted in the written comments. I think we are Handing it over next, I think, to Francois, who I think you almost gave sort of a segue into this conversation we're about to have about, you know, amount A limited to amount A, beyond amount A, tax certainty in the wider context, not just to amount A, and that's certainly one of the things that I understand Francois will be covering. Over to you.
Thank you, Akeem, and thank you for having the opportunity to present here. I'll do my best to keep this to about 5 minutes. As was just mentioned, I think in the years after the implementation of Amount A, we expect in the sort of the early years, we expect the uncertainty and the risk of the disputes that could be involved in applying Amount A should and will encourage a broad range of covered multinational groups to participate in the tax certainty process. The multinational group's participation in the long term is likely to depend on whether the process is effective at actually resolving the disputes and addressing any double taxation concerns. In our view, therefore, it's crucial to reach an agreement on a process that is effective, efficient, and fair to the taxpayers and to all participating countries. We also believe that in those initial years, the stakes for this are going to be raised even higher, given that the amount A tax certainty process will effectively serve as an audition for a broader application on the mandatory binding resolution process across other areas. As you mentioned there, Akeem, we've been looking at this as it relates between Amount A and potentially other parts of Pillar 1 and traditional transfer pricing. When we look at the interaction of Amount A and Amount B, we've given a lot of thought to this, and once again, this risk to double taxation to businesses. We believe double taxation can be addressed through tax reform design features, a lot of which have been talked about earlier today, plus a reliable dispute prevention and resolution process. On the design feature side itself, we've spent some time thinking about the extent that the Amount A and Amount B interact with one another, and how that might add to the tax uncertainty and how such concerns could be addressed. In our view, under the current blueprint, what we believe is that the purpose for Amount A is to actually reallocate some form of residual profit to the market jurisdiction, whereas Amount B's purpose is to minimize the disputes for baseline marketing and development in a manner consistent with the arm's length outcome. As we've heard today through the calls and the presentations, that there is some discussion as to what is the Amount A that is supposed to be reallocated. We would obviously look for some certainty in that. Is it any profit, any residual profit? So some certainty there would obviously help. But in our view, given the significantly different objectives of Amount A and B, we don't believe that there is any direct intersection. And as such, under the blueprint, we do believe that as long as under Amount A, the overall quantum of profit surrender between the payer country and the receiver country, and there's a clear mechanism for that, then we don't believe that there should be this intersection between Amount A and B. As we move on and think about the intersection of Amount A and transactional transfer pricing adjustments and current transfer pricing adjustments, this is where we actually believe that there's possibly some more gray areas and potentially more work that may need to be done. The blueprint itself actually recognizes that material transactional transfer pricing adjustments can affect the jurisdictions that the surrender Amount A to the markets, and that's captured in paragraph 789 to 791 in the blueprint. And the draft does commit to address these issues and suggests that an ICAP program could be a suitable mechanism. However, the draft also states that not much can be done until the design of Amount A is agreed. So we implore, we support trying to get some certainty around what Amount A looks like, and then we can address the other issues. But without a sort of a certainty and failing to develop a mandatory and binding resolution onto how these transfer pricing adjustments can and will affect Amount A, will lead to double taxation. We believe that without any mandatory binding mechanism, it's unlikely that governments will agree to a redetermination of which jurisdictions should surrender the Amount A tax base. Governments that see the residual profits reported in their jurisdiction, and if they see them substantially decreased due to a retroactive transactional transfer pricing or adjustment, we believe they're expected to correspondingly reduce the amount A relief agreed for that jurisdiction. Likewise, without a coordinated and binding mechanism, governments that see an increase in residual profits increase from a transactional transfer pricing adjustment are unlikely to agree to relieve more amount of the amount A. Akim, have you got a question? Sorry.
I think that makes a lot of sense to us. So thanks very much for coming in here. And I think also for highlighting, the interconnection that we also see, as you say, in the blueprint between potentially stabilizing amount A and the knock-on effect the transfer pricing adjustment might have on the identity or the quantity of relieving profit.
Just to conclude, I think what we're thinking is if a coordination problem can be resolved as between the amount A and transactional TP adjustments, then some of the simplified approaches we've seen that might work could work quite well, and some of those have been discussed. Two key issues that I do think would need to be addressed. One would be, obviously business would be wanting to be able to have some sort of guarantee that any numbers that are included in any simplified formula, any numbers that would be changed in any simplified formula should be run through the inclusive framework as opposed to letting unilateral or bilateral changes occur. Otherwise, it will throw off all of the calculations. And then on the government side, they would obviously look for something to be fair in the payer mechanism to ensure that they don't believe they're losing out. And I've seen other respondents say the same thing. And if those cannot be adequately addressed, then I think that we will find that there is continued uncertainty and disputes. So thank you, Akim.
Sorry for jumping in too early, and thanks for continuing. Thank you, Francois. With this, I think we would hand it over to Susanna, who will give us her insights both on the dimension of dispute resolution from the perspective of civil society, but I'm sure she will also have wider observations that she wishes to share. Susanna, the floor is yours.
Thank you very much, Akim, for having Oxfam here and for having the civil society. It's not a big number of us today, so I'll try to represent well the voice of civil society that's been very actively engaging through all along the process, I think since the very beginning, so more than 7 years now engaging on that. I have lots of problems with the internet, so I'll try to go straight to the point and be lucky enough that it's stable to finalize the presentation. So let me remind us what was the objective of amount A and what has been the concern with civil society since the very beginning. We've been very, we've been happy to see that this was a process that was going to redesign the international tax system, but the objective was to deliver tax certainty, but ensuring also more fairness, stability of the system, more redistributive capacity, and additional revenues, and in every country. So what we see at this moment is that we are far from getting to there. What we see is, from the blueprint is that we are adding a lot of complexity. It's been presented through all the sessions this morning. But especially the problem is that the redistributive effect is almost inexistent for developing country. And we'll see, and I'll come to that, that the problem with the scope and the thresholds would make it very difficult to be to bring benefit for some of those the developing countries, especially if we add some limitations because of the binding mechanism. So next. So let me start with if we're talking about tax certainty, as I was saying, this cannot be coming at the expense of redistribution or at the expense of making the system fair. We've been talking about, I mean, since we started this process, I mean, despite what some of the statement today, something that was coming clear is that the current system was not delivering well. It was too complex and it was very difficult to be implemented, and it was not covering well the different operation mechanism by large MNEs. So what we have, this idea of the safe harbor is just going into opposite direction of what was accepted, or there was a big consensus at some point. The amount A cannot become a safe harbor, giving the option to corporations to choose between what is the current system that was said to be insufficient and the new Pillar 1 rules. And it's a bit frustrating to be to see all this work and all this process. We have so big, more than 500 pages to have a system, that a solution that is just delivering an optional solution. So the incentive of the entire Pillar 1 was supposed to be delivering on tax certainty for corporations and avoid some risk of litigations with foreign governments. What we see is that there is a risk that is becoming just the opposite, creating confusion for governments, especially for developing countries that will not have the capacity to decide, but they will be in a situation where companies operating within their territory are making the choice, and this will not ultimately lead to an increase in the take-up of the measure. So the idea of the entire idea of the safe harbor is completely opposite with the principle of tax certainty that is supposed to be the objective of the blueprint. Next. The other element is that the arbitration, and we see that it's positive to the recognition that the dispute resolution mechanism has to be different from a mandatory binding arbitration. It's been said by many developing countries. I would say most of developing countries have been very clear in saying that this is completely opposite and not acceptable for them. We've been saying, and in the past, that there is a risk that it could create a parallel and less democratic system, and we want to insist on the idea that we should go into a dispute prevention system instead of a dispute resolution, and improve the different tools that are given to different countries, especially not the very big emerging economy, but especially also small and less developed countries. Otherwise, it's going to be extremely counterproductive for them and even create lots of problems with them. Next. To finalize, I mean, some of the reasons for having a very high threshold have been said to be to simplify the administration burden for countries. But here we have another. I mean, we're in a situation where the objective of make the system simple, less complex, and easy to administrate makes it, or is the risk that it becomes irrelevant for many developing countries. A high threshold of 750 million can become can be seen as too high for many developing countries. That means too little number of companies will fall under this scope, and will be also again in a very counterproductive situation. If many countries are endorsing the proposal and they will following, and they will be forced to follow this amount A, then we'll see that they will have very little benefits in terms of additional revenues. They will have very little number of companies following under the scope, but at the same time, they will have no capacity to adopt alternative solutions that can be more adapted to the national context, some unilateral solutions adapted to the context for companies falling below this very high threshold. So again, I mean, the aim that was pursued of simplifying the burden can be counterproductive for developing countries. Next, and to finalize, the success for us on the Pillar 1 should be measured on the capacity to generate those additional revenues. At this moment, it's very far from being the case. And at the same time, to secure redistribution, it's absolutely out of the scope at this moment, and more equity. Horizontal equity, as it was said before, yes, especially, but not only that. And I know it's going to be the center of the discussion tomorrow, but we cannot separate this from what is being discussed on Pillar 2. It's been said by many experts and by many different international organizations that developing countries are affected more proportionally more by the base erosion of profit shifting practices. So the solution has to be specially adapted to their problems. And therefore, we need these fairer taxing rates, of course, but we also need to make sure that we are giving the priorities to source countries to apply a global minimum tax through a subject to tax route at a high enough rate that some experts and organizations are talking about 20-25%. Unless we have this, the success of this massive work and its multilateral process will be not secure. Thank you.
Thank you, Susanna, and thank you for already taking us into tomorrow. It's a little preview, so stay tuned for tomorrow where we will talk about Pillar 2. I'm going to give it next to Isabel just for clarification. I think there's several terms of safe harbors that are floating around in these various pillars, and of course there's one safe harbor that's been proposed by the US at a point on safe harbor implementation, and then there's the marketing and distribution safe harbor. There's some other safe harbors, so we'll try to keep them all separate as we discuss and as we move forward. Thank you so much, Susanna. I think our last panelist here is Isabel Verlinden, who will talk about Amount B, the implications of Amount B. I think she's not only going to talk Amount B, but focus on Amount B, not Tim News Amount B, but the Amount B as you find it in the blueprint, and where are we here, what's the reality, where can we go, and what are some ideas for the future on this Amount B as it develops and its significance. And I think, Isabel, you also have some wider observations not related to Amount B. So the floor is you, and thank you for participating.
Thank you very much, Akim, and thank you so much for giving PwC the floor here. We're extremely grateful for that vis-a-vis the OECD, and particularly it gives a chance for us to give the opportunity to a lot of young people in our organization to work on the building blocks of a rational system that is practically aligned with intended results. So, and the reason for making this statement is important because I would like to go back to basics on Amount B and basics in terms of OECD transfer pricing guidelines. So if I could have the next slide, please, that would be great. So Amount B, and I know there is a lot of discussion on Amount A, and for obvious reason, but central for the successful operation of Amount A will be Amount B. Because if you're talking about chopping off a part of residual profit and reallocating that to the markets, it's also equally important to know what is not constituting residual profits. And this is the reason why we thought that, simplicity is extremely important in the context of certainty. We can get to a relative simple part of the solution by cornering Amount B very clearly. And we could root that, as I said, in the OECD transfer pricing guidelines when we talk about clearly about benchmarkable entities, benchmarkable marketing and distribution activities. So if I use transfer pricing jargon, these are those activities which you could accommodate under the transactional net margin method by selecting the least complex entity, the tested party, as we call that in jargon. So this suggestion from us is predominantly focusing on the idea of working through a qualitative indicator. So we could, for instance, work from a sort of an inclusive overarching statement that is drawing on chapter 1 and 3 from the OECD guidelines. What are we talking about? TNMM, so benchmarking the net margin. We are talking about entities that are having a lower functional intensity, entities that are not confronted with having to grasp with barriers to entry, particular consumer purchasing power or so in a particular jurisdiction. No, these are entities in a particular part of the value chain that have a certain limited functionality and for which it is very clear that they are not capturing the economic rent. And this would be the boundary between routine and residual. So So very important if you go back to those basics. Quantitative indicators in the blueprint, we read them. They are numerous there. And even though it looks pretty comprehensive, I would say it's hard to generalize. What about inventory? I'm almost 30 years in transfer pricing. Inventory, you can talk until the cows come home about should I make capital adjustments on that? What about operating expenses to turnover? Is there a certain bright line based on which I could say I reached tipping point and now I am passing the threshold of what would create a sort of a DEMPI function? So back to basics, very much the qualitative assessment. And the effectiveness of that would rest definitely on a widespread acceptance of underlying benchmarking analysis. So there are numerous instances where you could say that there could be a level of controversy on the approaches, depending on what taxpayers come up, depending on what certain countries come up with. But it is worthwhile the effort of coming to some sort of unified approach, having working party 6 work on a global benchmarking study based on mutually agreed search criteria. And this could be a moving target. And I'm talking about a pilot in a second, so that you can land on something on which you can then see afterwards, do we need to factor in industry-specific differences? Do we need to factor in country-specific differences? Do we need to make certain risk adjustments? And what's in there for the tax authorities, clearly they would surrender a degree of freedom, because you can't make those adjustments anymore. But on the other hand, in return for that, they get some incremental portion of the formulaic amount A. I don't see the screen anymore, so I don't know, Achim, whether you do.
Magic, it's reappeared just as you said it.
That's black magic. Thanks for that, Achim. So next slide, please. So what about the appropriate profit level indicator? There is a lot about that in the blueprint, and once again back to basics. Return on sales as a default, one could say very plausible. We know about that. It has been used and agreed on in many instances. But as I was saying earlier, the scale of the local sales function relative to turnover will not command economic rent capturing. So in other words, we could see whether there shouldn't be a sort of a corroboration based on which we could say we test the functionality against the operating expenses. And I'm going to name it the Berry ratio. I know there is some controversy around it, but on the other hand, also very valid guidance on that in the OECD guidelines. And maybe we could adopt a sort of a 2-layer test. So first of all, we talk about the qualitative test, so the TNMM test, and the second one being an ability to pay test. So if my return on sales would, for instance, lead to an odd result, which could be if I am in a sort of a high volume, a high margin business with very low distribution cost, well, maybe I could use then that Berry ratio as a corroboration. In any case, setting amount B too low risks to have to get us into a lack of possibility to land, but also setting amount B too high would equally lead to a wrong result, because you would apportion part of the system profit to the market where it may not belong, and over-reward sales and marketing functions that have no control whatsoever, no bargaining power to claim that. The narrow scope amount B, well, the narrow scope in the blueprint, we would suggest to expand that, as I said, by focusing on the TNMM threshold, so which is broader than what we have in the blueprint. So it's not a matter of talking about LRDs, commissionaires or whatsoever. It's about companies in the value chain that have no claim, no bargaining power on economic rent. Application at EBIT level seems to be a no-brainer for us, because the way a business is financed bears no relation to the return from its operating activities. So in other words, EBIT rather than PBT. And then maybe an idea from the Action 14 initiative from the OECD, Akim. And I know there was already 40 pages that we submitted on Pillar 1 and Pillar 2, but we submitted more on Action 14. And I think what's extremely interesting there, which we could leverage, was there are acceptable filing positions. And I mentioned here an example, US, Canada, a very interesting best practice approach on routine activities. So agree on a pre-agreed set on comparables. So start from the data, think about the assumptions, rework the assumptions to take out subjectivity, and come to some sort of bilateral safe harbors or agreed margins that could be laid down in memoranda of understanding going forward. There is also a lot of groundwork that has been done focusing on getting multi-country acceptance. Think about the work on low value adding services. Think about the work in the context of the EU Joint Transfer Pricing Forum, started in 2004, if I'm not mistaken, on sort of a global multi-country approaches to distributor returns. I know there are other stakes already being set in that direction by other firms. So, but take this, and this, now I'm coming to my next slide, as a pilot, as suggested in the blueprint, might be a good idea. But this last slide is particularly important, because in the context of certainty, and this encompasses amount B, but if we are thinking about coming up with a rational system to build the blocks of something which is practically reachable, then not only on amount B, but also in terms of allocation, in terms of Nexus, in terms of dispute resolution, maybe a very good idea could be to have a sort of a test, a pilot. And this is why we called it viability testing. And maybe we could leverage the initiative from the ICAP, see what sort of volunteering countries there would be, a few volunteering companies that would start doing the work and test the outcome of the work, and see then whether there could be a landing. For instance, you do that work and 6 months later, or you give 6 months to the inclusive framework to agree on what has been put there. And I know it's a cumbersome exercise, but it's worthwhile doing it because of the benefit. And then maybe that could set the stake to get also finally political agreement. Last point, 10 seconds for that, has nothing to do with amount B, but I can't resist the temptation to bring it up anyway, Akim. In our submission on amount A in particular, we also made a little bit of a naughty statement by saying, well, grappling with amount A and effectively looking at how to deal with the effective allocation, isn't that finally the work of governments? And what if we would think about a system where taxpayers would provide user data, customer location data in certain countries? Wouldn't that be maybe a good idea to do that, to leave that to the taxpayer and to leave then the rest to the governments? And they could, for instance, use their current accounts with the IMF to set up a sort of a netting system. So with this in a sort of a coconut shell, I would think on amount B and a bit more. Back to you, Akim, and thanks again for giving me the opportunity.
Thank you very much. Very insightful, and you will not be on the naughty step at all. Thanks also for sharing your thoughts beyond amount B and inside amount B, and sketching out what some of the challenges might be, and also helpfully giving some indications what the path might be to emerge from those. We're at the end of the first panel round. As we said, I would want to give the floor to anyone on the panel if you want to either add anything that now has occurred to you on anything that you've said or list has said. And clearly you can see, for instance, if you list to Isabel and the amount B as it's conceived, and sort of building up where we can go within the existing system. And then you have Tim with really as a new system on Amount B. You see that sort of there are some ranges here and policy choices that we'll have to make as we move forward. So just giving it back to any one of the panelists if you do want to come in. If not, you don't have to, then we go to the discussants. But I did want to give you, we're meant to be a panel even in the virtual space, the possibility of either expanding on what you said or maybe, you know, sort of reacting to anything that you've heard from your fellow panelists.
Akeem, the only thing, this is Francois.
Go ahead.
The only thing I would add, and it ties into what was said on the, I think on the prior panel, is at this point in time, I think simplicity is going to be part of the key to moving things forward. And as was mentioned, maybe that does involve a sort of a risk-based approach, but I think that is going to be critical to move it forward without introducing additional complexity that may be more than certain countries and maybe even certain taxpayers can actually deal with.
Yeah. We will certainly take that away also for Pillar 2 and for tomorrow, where I think similar thoughts. But I think, Tim, maybe you had something yet?
Yeah, I kind of skipped it in my earlier discussion, but I think in talking about the stability long-term and the need for theory, I challenge the assertion that marketing intangibles are a viable connection to excess returns. Our business is typical of many, and particularly consumer products that are frequently used. Our focus is daily use. And no matter how much we advertise, we think that supports people trying the product and reminding them of the benefits of our product, which supports sales volume. But at least in our industry, it has almost no connection to excess returns. And the reason is they buy our product and they use it at home. No one knows if you're using our products or our competitors. So favorable images is economic nonsense to produce excess returns. If we can earn excess returns, it's because we have a superior product at a great value both to the retailer and to the consumer, such that they'll pay at the price point. And that's a performance-driven concept. That's for the product's efficacy. It's also a supply chain comment. How efficient are your costs determine how much margin you can earn. And if you're inefficient, obviously you're not going to probably have excess return. So I challenge the premise upon which Amount A has been built. And that's the reason why we reconfigured how to do a taxable presence versus a non-taxable presence as a better line drawing, and then within it, a reconfigured jurisdictional allocation, which kind of ensures there's no double counting. The current distribution and marketing safe harbor is directionally a great step in the right direction, but the metrics of how it was presented, a 4% return or higher is more than arm's length results. So almost by definition, those that are in both Amount A and B are going to have excess returns payments embedded in both parts, so double counting. So that's also a reason to kind of unify the jurisdictional additional taxing rights with the arm's length distributor return that Amount B aspires to calculate.
Thank you, Tim. Is there, we note, that when we put out this marketing and distribution safe harbor, it was put out the concept, and as we indicated in the print, there's much left to be designed, and it was mainly putting out a notion that if residual profit is in the market, then maybe there shouldn't be an additional Amount A allocation. And so one of the benefits of this is also getting better ideas of whether there is support for this concept, and if it is, what's the best way of building it. If there isn't, yes, go ahead, Sujit. Yes.
Yeah, I just wanted to take up from a point that Isabel made about having the IMF, for example, function as, let's say, a clearinghouse of sorts. And I think that it goes again to the point about promoting studies that would enable the understanding of users and data and the value of data. And I think that that's ultimately the objective, being that businesses would leave it to governments to figure out where taxes are due and where they have to be paid, and that's a certainty aspect, but it has to be based on studies, and therefore clearly that's a development activity that would be useful for the inclusive framework to undertake.
Okay, then I think if there isn't anything else from the panelists at this point, I would invite our discussants, and I can already see Alison luckily unmuting herself, so she's ready to speak. I think most of you know her. She's a partner at Deloitte, and she will tell us, the realities, I think, of also administration, which is a key part of all of this, because this is actually what taxpayers would see, how we can streamline and think of administration following on perhaps from a streamlined tax certainty, but then where does it go in administration? And she'll also share any wider ideas that she has in the wide field of tax certainty. So thank you for being with us, and the floor is yours.
Thank you very much, Akim. Yes, after 10 months working at home, I can finally manage to unmute myself at the right moment. Thank you. I have 3 points, I think, to make on the topic of certainty and administration. So first off, in relation to certainty and the panel's process. So as others have said already, obviously it will be essential on Amount A to get to agreement and to certainty at the end of the process. And that's essential to make sure that there isn't, double tax or multiple layers of tax unnecessarily. I think that the review and the determination panels that have been proposed by the OECD in the blueprint generally work well as a concept. It will be important that clear timelines are established to make sure that the process operates smoothly. And there is a challenge there, as others have mentioned, in relation to audit adjustments, in particular, significant or material transfer pricing adjustments. But nonetheless, having the timetable set out clearly for both businesses and for tax authorities of how the panels will work will help to move everybody forward to certainty as soon as possible. And I think one of the other points to note is that the objective, I think, should be that the determination panel should be used on as few occasions as possible, that the purpose of the review panel will be to, wherever possible, get countries to agree to the outcome. And I think that may be an achievable goal in some cases. When we think about those issues that might be more challenging, I think there are two key areas that look at this stage to be the ones that will most likely need to go to the panels. The first is the question of scope and which businesses and which parts of the businesses are within scope of Amount A. And the second is around paying entities, particularly for decentralized businesses. And the blueprint acknowledges that there may be the capacity for there to be a separate process on questions of scope. We think that would be a very helpful and very useful approach, not least because many of the scope questions are likely to come up in year one. And obviously that may be a phased year one if there is a phased introduction of Amount A. But nonetheless, it would be something that would help businesses early on and would allow them then to move forward with their compliance with Amount A, or to understand that Amount A is not for them and they can focus on other areas. The paying entities question is perhaps the one that will take more time to resolve and would be something that would be needed along with perhaps some other issues for the longer term panel process. But broadly, we support the ideas put forward by the OECD, and we think that this is probably the best solution to getting to resolution of disputes in the end. And then my next comment really is around the administration of Amount A. And we agree with the recommendation in the blueprint that the return for Amount A, or the calculations for Amount A, should be filed with the tax authority of the parent company jurisdiction and then shared in whatever is the most appropriate and convenient form with other participating tax authorities. We have seen from the work on country-by-country reporting that this can work extremely well and be a very efficient way of filing. But we also note that there have been problems with and issues with local filing. Personally, I've seen situations where local filing has not been intended to be applied, but has been applied because of issues in exchange of agreements. And it's also been difficult where there have been local requirements that maybe meet, local existing tax administration practices, but nonetheless require businesses to produce the same information in slightly different formats for the local filing processes. And the only reason I mention this is just to make sure that wherever possible, these kind of frictions are removed in the design of the Amount A administration process. And that would include, where possible, removing the need for any kind of local notification process around Amount A, but instead relying on the filing of the Amount A return and the sharing with all tax authorities. And I realise there are complexities, some for developing countries more than for others, but if we can address those up front, I think long term it would go a long way to reducing compliance costs for businesses that don't necessarily add any particular value for tax authorities. With that, I think I'm coming up to the end of my allotted time, so I'll pause there and happy to take any questions I can.
I need to first unmute myself. See, I've been also 10 months in lockdown and I still can't unmute myself. So the learning curve is much faster on the private sector side than in an international organization. So, but thanks a lot for those insights. And yes, the hope would also be that the existence of the resolution panel brings the review panel to the resolution, a bit like some of the thinking around arbitration, which I guess ideally is intended also not to be used, but there as an effective means to get agreement at the competent authority level, at the MAP level. I think we turn over next to Elseline, who has also unmuted herself and turned on the camera, so I can see her now. So the floor is yours. And
thank you, Akim, and hi, everybody. I'm very pleased to virtually be here. I realized that this panel is on tax certainty and administration. But I did want to start by saying, and it has been said before, that tax certainty actually also starts with simple rules and clear rules. So I was very happy to see some very interesting suggestions, for example, the one by J&J and Procter & Gamble on simplifying the current proposals. We have also included a suggestion for simplification in our own submission. We've called it a corporate market tax. It's a suggestion to simplify how you calculate Amount A. Basically, it takes the relatively simple computation of the digital service taxes that we currently see, but it combines it with the creditability of a corporate income tax. And a quantitative profitability test could then be applied potentially to determine which M&E groups would be in scope of this corporate market tax. And the rate could potentially vary depending on the profitability level. So just wanted to put another simplification out there before I dive into the topics that have just been discussed by the panel. But, even simple rules can lead to discussions. So we really truly applaud the OECD for including the early tax certainty process to prevent and resolve disputes on Amount A. Based on our own experience currently with transfer pricing and PE discussions, a binding outcome in the end is a must. And even though I hear Susanna from Oxfam clearly, I do want to say that I think we're all on the same page because nobody wants in the end a binding resolution. I think this is really just there in those hopefully few cases where no resolution can be found. So hopefully the process that is in place to resolve disputes will be, good enough to get to a solution together, and that we don't have to, in the end, go to that binding solution. I think we're all on the same page, and it should just be there for the cases where no resolution can be found and to avoid double taxation for businesses. Then I would also like to echo Alison's comment on, that there should be maybe a separate process for scope questions. Also, our business, which might seem simple from the outset, is getting more complex with new products and new services. And to get certainty on whether some of those products or services would be in scope or out of scope of amount A, we would definitely make use of such a process to get certainty on that. Then another important element of tax certainty, and I'm sorry that I'm repeating this, I know you've heard this a lot of times, but it is definitely the removal of the unilateral measures upon consensus. This is mainly, of course, addressed to the inclusive framework. I know you know this, but I really want to stress it again because this is so important, I think, for many businesses. Then specifically on amount B, I thought the presentation from Isabel from PwC was interesting. I think that we do support a narrow scope for now, just for this, since there is a need to keep things simple. Maybe we should first give it a try with a narrow scope, because broadening the scope would probably make it more complicated. So let's first try and test it with a narrow, and if successful, and after we have a narrow scope, maybe we can broaden the scope. Then last but not least, and this might sound a bit like a plea, and maybe it is sort of a plea, on behalf of Booking.com, and I think also on behalf of many other stakeholders, I would really like to urge all governments to throw in their weight behind this global agreement this year. The alternative, as we all know, of bilateral measures will result in double taxation, in fragmentation, and in triggering legal disputes and trade conflicts, which is the last thing that the global economy needs in this severe crisis. Please remain optimistic, like Tim said, and please strive for a consensus this year. We really
Thank you. Well, we're happy to take that on board. That's what we're trying to do. We are by definition optimistic. And I think also the feedback here shows that whenever there's a problem, many of you also have ideas how we can solve it. So, taking a page out of, sort of the assembly point that I think Tim's also made, there's got to be a way of putting these elements together so that we have the degree of certainty that we need, but with taxing right allocation that we desire. And putting these elements together, so that does make us remain optimistic. Also, to keep the optimism and responding to the 2 points that have come in, thinking was that there could be a, so to speak, fast track scope type ruling process that would be separate in addition to the wider one. But the question really was, I just need to have, first of all, certainty, am I in scope? So we do not have situations where if you operate in 60 countries, 20 of them say, well, this is in scope, and 40 say they do not. That would not be a viable system, and it would defeat the whole point of what we're trying to do here. So I think with this, I'm handing it over to our last discussant, who is Christopher from Verizon. I can't see you right now, but I'm sure that you will be coming in here. He's our last discussant for the day. The floor is yours.
Thank you, Ahmed. Hopefully you can see me now, and also like to thank the OECD for allowing me to participate with this distinguished panel. This is great. Also like to thank Tim for raising the issue of segmentation as part of his proposal. We really believe that taxpayers really should be allowed the flexibility to segment their results based on their books and records, and really shouldn't be limited to consolidated financial results or publicly disclosed segments. We really believe that if you have those limitations, that distortion could occur, because I think there could be unintended consequences if you don't allow the segmentation of unreported segments. Like in our case, and I'm sure with other taxpayers, our accounting rules kind of preclude reporting certain segments based on materiality and SEC, U.S. SEC rules, and et cetera. And so we really feel like if you start with the allocation of consolidated financial results, distortions could result, particularly if you have like an excluded business, for example, or like I said, an unreported segment. I thought like Tim's point was spot on when he mentioned that the allocation based on consolidated results could have the unintended consequence of like including results from a wholly domestic business as part of Amount A, and in that case we feel like distortion would occur, and we feel that's not the purpose of what's trying to be accomplished. I'd also like to talk about the concept of a phased approach. We feel like a phased approach kind of makes sense, maybe starting with ADS businesses. We think it would allow tax authorities to kind of build administrative capacity, which we believe is very important in these distressed times. We also think it could facilitate a more timely implementation of pillars 1 and 2. Also, we think it would allow like issues to be worked out before a more broader implementation of consumer-facing and other businesses. Of course, as a condition for even a phased implementation, we strongly believe that uniform unilateral DSTs really need to be eliminated as a condition for even a phased implementation of pillars 1 and 2. And that's it, Akam. Unless anyone has any questions.
Okay. Thanks a lot also for reminding us on the phased implementation and the removal of unilateral measures. So it sort of brings it back. Also to I think the pillar of the first panel that we had of the day. I don't know whether any of the panelists want to react to any of the comments from the discussants. Otherwise, we do have Eric also on standby, I think, and he may have been monitoring whether there's any particular questions that come in. A little bit of time, we don't have much time, but maybe over to you, Eric. I'm feeling like on CNN, I'm giving out from the operations room to Eric, who stands somewhere in a snowstorm.
Thank you very much, Akim, and hello to everyone. Yes, we've received many interesting questions and comments from the floor. So thank you very much to all the participants who submitted their questions. Now, because of the limited time that is left, I just picked up one question, which was for you, Tim, in particular, regarding the proposals that you have outlined in your submission and also today. And one question that came up is whether you could clarify a bit your concept of scale without mass businesses as a way to determine the scope of Amount A and how this interacts with what seems to come out is that the idea that it's a kind of physical presence test. So I think some clarifications on that concept would be very welcome by participants.
Sure. So I don't profess to be a digital expert, so these are more distant impressions, but I think you would strive to have multinationals generally be in one of these two mechanisms, either taxable presence or the absence, which for shorthand, we just call it scale without mass. I think if you're looking at definitions, you probably could build off a broad interpretation ADS. It certainly, I think, would have sales thresholds like the current blueprint, both at the country and at the enterprise global level. What I did indicate a nuance is, in addition, there needs to be the absence of a local counterparty, a local distributor or service provider if you're a service company, because one of the fundamental original objections and why DSTs came about was there was a large and almost uncapped ability to economically exploit a market without being a taxpayer. And if you look at some of the platforms, there's an implicit exchange of user participation with the platform in exchange for a free service. But the ability to tax that is, more than difficult. It's almost impossible. So it was one of the drivers for a DST originally. That doesn't correspond to a traditional business model who has either a third-party distributor or their own affiliate. when we looked at our data, there's a footnote in our submission that indicates how very little will actually go to markets where we don't have a taxable presence. The real reason we don't have a presence is because there's not enough sales volume to support the business. It doesn't break even when you include all the costs. The cost of operation and maintenance are higher than what that taxable presence derives. So that's why we're not in a market. Otherwise, we are. We're in it because of things like I alluded to. The logistics costs are important to control. They're a bigger cost component for us than cost of goods sold generally. It's because we want to control the brand. We think our own people can actually manage the brand and grow the business faster and more effectively than third-party distributors may. So there's a natural pre-tax imperative for us to create a taxable presence once it becomes viable. But for those markets where we aren't, the amount that we calculate that they would get under Amount A it's not a whole lot more than the administrative cost to operate the system. So the reason I excluded traditional business models where they have a taxpayer in country who takes it the next step is because there really is very little revenue to get under this expanded Amount A. And in my view, it's not worth the administrative cost or the line drawing, or as was referenced, the difficulty in sourcing. Who is the ultimate consumer? That's pretty difficult to do in an income tax principled way. And so for those reasons, I carved that out.
Thanks very much. I think that's probably as much as we have time for. We could perhaps ask another question, but then we couldn't answer it. So there's probably a little point in doing it. We'll take those questions away. I will not attempt to summarize all the insights that you have shared. One, because I wouldn't do a better job than you have. Two, I would go over time. And three, I think Pascal will be concluding the day with a summary of everything that we have heard. So we will do that. Suffice it then maybe just to thank all of you for taking the time of sending in the submissions, and that's not just to the panelists and to the discussants, but to all of those that are listening, to all of those that have sent in these submissions. As you can see, hopefully, I hate to say this, but I do mean it, that if you listen to all the interventions we've just had, a certain degree of optimism is justified. I think people have pointed out where the complexities are, but importantly, people are also pointing out what some of the solutions could be. So if we're all capable of taking all the input that we have and continue the engagement here, there certainly is a path forward. And with that in mind, I think I hand it back over to you, Martin, as the chair. Thank you very much to all the panelists and discussants once again.
And thank you, Achim, very much for moderating this very interesting panel. Also would like to thank the panelists and discussants for sharing their views, for their input, and also for expressing concerns sometimes on various aspects on Pillar 1. I think the discussion addressed a lot of aspects and key elements of Pillar 1 that have already been discussed in the steering group of the Inclusive Framework, and that will continue to play a very big role in our discussions in the steering group and in the Inclusive Framework as such. Having a clear understanding of what the problem behind Pillar 1 actually is, I think that is also a key aspect, and I think it was Lisa Wetlin from Netflix who asked that question in the first panel, and I fully agree, but the difficulty sometimes is finding a consensus on that, finding a common understanding of the problem and finding a shared understanding of the problem. So I think many countries in the Inclusive Framework, they have an idea what they would try to solve behind with Pillar 1 and what the issue behind Pillar 1 is, but finding a shared understanding, a common understanding of the problems, that is one of the difficulties, I think, when it comes to the discussion of scope in particular on Pillar 1. Simplification, of course, is another very important issue, very important aspect too. Simplification is sometimes on the expense of accuracy. that we always need to keep in mind. And I think the big challenge here is to strike a good balance between simplicity on the one hand and accuracy on the other hand. Tax certainty and how to get tax certainty, also an important point. I think the good news is that we are all obviously of the view that we need a globally coordinated solution, an internationally accepted solution, as opposed to a variety of individual domestic approaches. So international coordinated solution, I think that is the best guarantee to prevent double and multiple taxation and the best way to get tax certainty. Again, thank you very much for the discussion today. We did have, by the way, a very large audience today. More than 3,000 people followed our discussions. More than 400 had registered on Zoom, and we had another 2,500 people following the discussion via OECD TV. The discussion tomorrow will focus, as we all know, on Pillar 2. Day 2 will be moderated by Marco Juvenale, who is the chair of Working Party 11. And yeah, I look forward to the discussions tomorrow as well. I wish you all a nice remaining day. Stay safe and healthy. Bye-bye.